morning. It is Monday, December 5th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman alongside Brad Smith, and Brian Sozzi is back with us. Let's get to the top three things that you need to know as the clock hits 9 a.m. We've got the big reveal. Yahoo Finance has crowned the 2022 Company of the Year. We're going to bring you the details plus interviews with top executives all day here at Yahoo Finance. You don't want to miss it.
Oh my, I wonder who it is. But first, a check on the markets. Futures are slightly in the red here to start the week after a better than expected jobs report on Friday cast doubt on how quickly the Fed can ease the pace of interest rate hikes.
Plus, stocks in Hong Kong and mainland China are in rally mode after local authorities took more steps to ease COVID-19 policies, giving hope of a full reopening in China.
But we begin today with my favorite story. The end of the year is upon us, and that means the Yahoo Finance, we have unveiled or officially announced its 2022 Company of the Year. The land of $1.50 hot dogs and unmatched customer loyalty takes the crown this year. And you guessed it, it's Costco, folks. I flew out to Costco's stomping grounds in Washington to go inside the retailer's business. Here's what I learned.
Costco has seen a lot since opening its first warehouse store in Seattle, Washington in 1983. 7 presidents, the aftershock of the early 1980s inflation and subsequent sky-high interest rates, the Great Recession, and more recently, a health pandemic, the likes of which many have never lived through before. Yet today, Costco has more than 842 locations in operation spanning 14 countries. For the year ended August 28, 2022, Costco hauled in an astounding $227 billion in sales. The company has triumphed in its nearly 40 years since that first store opening. And some retail watchers would argue that out of all the turbulent economic cycles Costco has endured since its founding, 2022 was its most volatile.
Shoppers are adjusting their spending habits. It makes for a little bit of a tougher holiday for the consumer.
You're in a full-on inventory crisis as we go into the holiday.
It's a horribly challenging environment.
But it was also a great example of the power of a Costco business model that has historically rewarded both shareholders and the members that walk into its enormous warehouses.
We've been members for like 20 years, and we love coming to Costco.
We do get the value of the membership, that's for sure.
It's easy and there's everything here.
Craig Jelinek has been Costco's CEO since 2012, and I caught up with him at the opening of the company's latest warehouse some 45 minutes north of Seattle.
What is the ticket or key to your success in your view?
Well, I think it's just exciting merchandise. We've always been known that everybody likes to talk about our treasure hunt. You better buy it now because it may not be there tomorrow. But I think creating high quality goods at a great value, that's what we do.
In a year of eye-popping inflation for everything from gas to eggs hammering households, the retail warehouse giant opted not to raise the cost of a membership, even as rival Sam's Club did. Costco served up some of the cheapest gas prices in town when prices at the pump were sizzling in the summer months. The company was often the last grocer to raise prices on households despite biting price hikes from its vendors.
To top it off, the Washington-based retailer kept the price of its legendary hot dog and soda combo intact in a year of high inflation, and also continued to offer employees some of the best compensation packages in all of retail.
For all its efforts, Costco was rewarded with impressive sales gains seemingly every month of the year, a stock price that relatively outperformed the S&P 500 and Yahoo Finance's coveted Company of the Year award.
Of course, hat tip to Costco, but also a hat tip to the Yahoo Finance team. We have a lot of content now on the Yahoo Finance homepage. We have a lot of content rolling out this week. This is a heavy lift to get out these type of projects, so my hat's off to them. But it was interesting. So I spent the day in this new Lake Stevens store, Costco store in Washington, and I asked them, well, why are you opening up this store seemingly in the middle of nowhere? They have a store 10 miles away that is now pulling in $400 million a year in annual sales, just one Costco store. And he said, we need a store to take that overflow traffic. So what did Costco do? 10 miles away, they opened up another store, and it was packed by about 11 o'clock.
Wow.
Yeah, we've seen a huge shift in the consumer sentiment around where they're trying to find deals, where they can buy in bulk perhaps and be able to save on a per unit cost. Costco plays right into that. We've seen similarly some of the success within this broader category too. You look through some of the numbers that even Walmart has put out for Sam's Club this year. This has been a year for growth for the category, but Costco getting Company of the Year here, huge honor, and ultimately we'll see what type of overflow we see into 2023 given some of the economic signals that we've seen thus far and where consumers could be even more cost conscious there.
I mean, that said, Costco has had some speed bumps, right? To your point that you were talking about in the package, I mean, the stock is still down on the year, is it not?
It got hit last week when they reported those November sales. And the analysts, and I go a little bit into this in the Morning Brief newsletter, this is stock that for as long as I've been covering it, maybe close to 20 years, has always been priced for perfection. What does that mean? It trades at a richer valuation to the broader market. And that means every quarter, every month, Costco has to do amazing things. And what they showed last week is their sales slowed down month over month. And I talked to the CEO and he said, we're seeing some slowing in key parts of the business like TVs and jewelry. And the street doesn't want to hear that stuff.
Yeah, it's also in the international segment, too, where they're seeing some of that slowdown, and they acknowledge that this is a company that does actually give us results on a more frequent cadence than just quarterly. We get monthly numbers from Costco, too. And so that really showed up in not just the e-commerce segment, but in some of the other international categories where they're actually, over the past 4 weeks, seeing declines of about 1%. And then that ultimately, as I was mentioning, the e-commerce number, that was actually down over the past 4 weeks by about 10% for the month, too.
I'm looking back over the past 20 years of Costco stock performance. In the past 20 years, 3 down years.
Wow.
That was
It's a beast. One thing I was reminded of, too, the treasure hunt mentality in this store, it's not just cheap stuff. They were selling $2,000 bottles of wine, $3,000 electric scooters. All this stuff is in Costco, and it's buried on their website, but when you go in there, you see these more expensive luxury goods.
It's a good place to get some cheap golf balls, though.
I didn't buy you a bottle.
I still have not gotten I moved to the suburbs. It has now been 2 years since I moved to the suburbs.
You're holding out.
Still haven't gotten the Costco membership. I don't know why. There's just a lot of other things to have to worry about. And to get a Costco membership and have another store to have to go to.
You be you, Julie.
I don't know. Maybe eventually I'll do it. We'll see. We'll see what happens.
We're going to keep a close eye on shares of Costco here, but once again, that's our company of the year. Everyone, Chinese stocks, we're also tracking those this morning. They're rising today after Chinese authorities took further steps to ease COVID-19 restrictions that have weighed on the country's economy. On this news, Morgan Stanley has lifted its outlook on China to overweight from equal weight. That's its first upgrade since January of 2021. And there's a lot to really break down here, but some of the biggest moves, you're seeing that within the Hang Seng Index as well for technology. And really just this move away from what a move away from a zero COVID policy would look like for China. That's what the market is so reactive to here this morning.
Yeah, but considering everything that's going in the world right now, top tickers on our site, NIO, XPeng, at one point, pre-market, I was checking up 15%. Big moves in these stocks, but can you trust it? Can you trust that China's going to get this reopening? Because you mentioned before, Julie, we were here, 3 weeks ago, saying the economy was going to reopen. Then we had a couple more weeks of lockdowns. Apple got tossed into the mix. The market went down, and now we're back to reopening?
Well, and even to be clear here, that's because the Chinese government is giving these signals that it is opening up. To be clear, it is very geographically mixed within China right now. Beijing is still closed. Shanghai showing some signs of opening. And it really is all about the flow of where they are seeing cases. Cases do seem to have potentially peaked. There were just over 29,000 COVID cases reported for Sunday, which is the lowest in about 2 weeks' time. So it seems like they're on the downslope of their recent spike in cases potentially. And it's still, they've kept the cases much lower. The challenge for the Chinese government is reopening when they've been clear that reopening can be very dangerous from a health perspective. So now they're trying to manage through and say, well, COVID is survivable, et cetera. So sort of changing the messaging a little bit. But it is pretty extraordinary that they do seem to be reacting to all of the protests that were going on, and particularly protests that were happening around workplaces like Foxconn, for example. Foxconn, by the way, or AKA Han High Precision, which makes a lot of the Apple products, has said they are still operating a closed loop at their facilities. So that's something to note as well, even as we do see some government noises about reopening.
Yeah, they had basically said that revenue in November, that moved lower by 11.4% year over year. And that really factoring a lot of the production related problems. Apple, this has also flowed through to them. Many investors have had kind of time to price this in, but over an extended period of time, if you do see a hit to production like we have, that leads to some of the calls that you got on the street from Wedbush, from some of the other firms that cited the issues of production and not being able to have enough supply at a time where in the holiday season, trying to churn through and ultimately hit some of that demand or reach some of that demand, where that is amazingly critical, even going into the next year to set up for what is essentially the Q1 for Apple, I believe, their fiscal year for right now.
Right, and Foxconn also said it's going to be returning production back to normal. One more note, by the way, on the strategy front. there have been a lot of Wall Street banks that have been coming around to the China story because of the hopes around reopening. Morgan Stanley becomes maybe not the last, but one of the later ones to kind of join that bandwagon and say that they're turning bullish again because of potential reopening. That said, they're putting reopening a little bit later next year in April. There is some optimism it could happen January, February, but they're talking a little bit of a later time frame. Still, they like China stocks here, so kind of interesting. And we did see a rally occur overnight in China, as well as seeing those ADRs rise here in the U.S. All right, let's also turn to thing number 3 this morning. That has to do with oil. Oil prices, they are also moving higher. OPEC Plus agreed to stick to its existing policy of cutting oil production, a decision made as producers face uncertainty over Russian sanctions. But there is one area of Russian sanctions where we do have more certainty now, and that is the $60 oil price cap that EU nations and a bigger group decided to impose. At the same time, all of this China talk, that's helping oil too. So there are a couple of dynamics that are working in oil's favor right now. There is the China reopening. Of course, China, a big consumer of oil. There is the production targets coming from OPEC Plus. And there is that oil price cap, which has happened sort of as expected, even as Russia is pushing back against that.
Yeah, it does seem like the reopening trade in China is the bigger story here. I'm just looking at some of these oil stocks pre-market, not seeing big moves in Exxon, you name it.
Yeah, this essentially just makes sure that there is this 2 million barrel per day production cut that was decided in October that ultimately kind of just get reinforced here. And this was an untimely, or not untimely, but it was an abnormal timing for the meeting itself. They pulled up the meeting, typically would have taken place during the week, emergency Sunday meeting. This is the decision they come to, and we'll see ultimately what other kind of discourse moves forward from here, because it seems that some of those that were in the discussion for OPEC, some of those members were actually looking for increases in production as well. And so without that increase in production, now it just brings a larger market reaction question for an extended period of time, at least here in the interim period.
Yeah, and I was joking last week, I wrote a morning brief that talked about erasing the gains for the year in oil prices, and I joked that was a sign that maybe oil prices were bottoming, and yeah, that's what happens. We've seen oil rise about 8% since then. So
be sure to sign up for the Morning Brief newsletter. You can read Julie every week.
Yeah, it could be contrarian, maybe
Absolutely.
It could be contrarian indicator.
It's all free, baby. It's all free.
That's the idea.
Yep. Coming up, everyone, why our next guest says the uncertainty surrounding inflation and fiscal policy remains sizable. We're going to speak with the strategist from Bank of America next. Welcome back, everyone. Stock futures are lower as investors keep a close eye on economic data ahead of the Fed's December policy meeting later, as traders are debating the trajectory of Fed rate hikes. And joining us now on what might be in store for the markets in the year ahead, we've got Mark Cabana, who is the Bank of America Global Research Head of U.S. Rate Strategy. Things are buzzing over there on the floor. So tell us a little bit more about your thesis, particularly as we get in to 2023, and particularly how it relates to the Fed. I mean, it's pretty much signaled that it's going to be a 0.5% hike at the next meeting.
That's right. Yeah, we do think 50 basis points at the next FOMC meeting in the middle of December. We think another 50 after that, and they'll conclude with a final 25 basis points at the March meeting. So the terminal rate we think will be between 5 to 5.25. Now this is slightly above where the market is priced, and we do think that the Fed has more work to do. We do expect that the Fed is probably going to sound a bit more hawkish at the December FOMC meeting, simply because we've seen financial conditions recently ease, and the Fed's going to have a hard time lowering overall inflation while asset prices are rising. So we do expect that the Fed's going to sound a little bit more hawkish in the near term, very consistent with some, let's say, well-informed journalists who've recently been publishing something to a similar effect. Now, we think that after the Fed gets to reaches 5 to 5.25, they're going to remain on hold for a considerable period of time. And we think that they'll probably start cutting rates in December of next year as they see the overall economy moderate, they see signs that inflation is coming down, and they will also see signs, importantly, that the labor market is slowing, and they'll be seeing the unemployment rate. That'll give them confidence to proceed with those cuts. Now, one of the challenges that the Fed has today is that the market is already well anticipating these cuts. The market is pricing in almost 170 or so basis points between the middle of 2023 and the end of 2024. And this type of rate cuts are somewhat unprecedented in terms of the history of Fed tightening cycles. And it means that the market knows that the Fed's going to stop at some point, let's call it between 5 to 5.5%, but then they don't think that they're going to be on hold for all that long. And they're well anticipating the rate cuts. And that's really what's been driving the easing of financial conditions recently. It's less about the terminal rate, it's more about the cuts that are priced. And the Fed's going to have to push back on that notion if they indeed want to try and be successful on inflation in any material way. Okay, I know that was a lot, so I'll stop there.
I mean, no, I'm saying, oh man, because like everybody's all about terminal rate, and you're saying now people are focusing on the cuts that are coming once again. So it sounds like you think that scenario is incorrect, that if the markets are focusing on cuts that will be coming maybe even later next year, and trying to price that in, that is a mistaken strategy.
Well, I think that it creates a real challenge for the Fed. Again, we expect those cuts as well as a research house. We think they are likely to happen. But if you're the Fed, the challenge that they have today is that they're trying to aim for a slightly lower terminal rate, and then they're trying to say, no, we're going to be on hold for a long time. Higher for longer is the narrative that they've been running with. The only problem is that the market doesn't see higher for longer as credible because they're pricing such an extreme amount of cuts after the Fed reaches terminal. So even though the Fed is saying higher for longer, the market is saying, yeah, we know you're going to be cutting at some point. We trust that you're going to be cutting quite meaningfully. And then that's what's been easing financial conditions. So what does the Fed do? Well, they've got two choices, we think. Number one, they can try and more credibly convince the market that higher for longer will stick. They can do that, let's say, through the 2024 dot and the summary of economic projections that they'll release in December, or they can do that by trying to provide some explicit forward guidance, saying that we will not cut rates unless the unemployment rate is at, let's say, 4.5%, or inflation is 3.5% or lower, or something to that effect. That's how they can reinforce the higher for longer. But if they're unwilling to do either one of those things, the only option that they have is to keep hiking rates. And that may mean that 5 to 5.25, as we think, is low. It could mean that they end up delivering something that's closer to, let's say, 6%. But this is the challenge that the Fed has today. And again, it's rooted at the core in the fact that they're probably not going to be able to get inflation to come down as long as financial conditions are easing, as long as asset prices are rising. And they've got to address this because right now the market just thinks that the Fed is going to pause and then they're essentially done. And the Fed still has a lot more work to do.
Well, then, if that's the case, Mark, should someone fade any rallies in the broader equity market?
Look, we do think that this environment does create material headwinds for risk assets. The Fed's job is not yet done. And don't believe me, but just look at the wage data that we had on Friday. It's very strong. The labor market is still extremely tight, and the Fed still has more work to do. Now, again, what the equity market, what broad markets have heard and really wanted to hear from the Fed is that, okay, they're done, the pivot's here. Powell last week didn't sound as hawkish as he had previously sounded. Therefore, it's okay to take risk. And again, if you're the Fed, this is not the outcome that you need in order to really credibly bring inflation lower. So again, we do think that the Fed is likely to deliver another dose of hawkishness at the December meeting, and we do think that that's going to create headwinds for risk assets, and maybe not ensure that this particular equity rally has legs.
And so, Mark, put it all together for us from a strategy perspective. If risk assets maybe are going to get walloped a little bit, where should people go? And particularly, if you can, through the lens of a retail investor and how they could play this.
Sure. Well, so what we've been recommending on the interest rate side is that we've been suggesting that investors try and lean long duration, at least at the back end of the curve, and particularly do so in a way that protects you from inflation. We really like longer dated tips here. We expect that longer dated real rates are going to fall and that all else equal break-evens or inflation break-evens are going to be biased a little bit higher. We expect that long dated real rates will fall simply because the economy is going to be slowing, and there are good chances that the Fed, let's say, pivots before we see inflation back down to very close to 2%. We could see the Fed change their policy stance as inflation is falling, but the Fed might end up accepting a slightly higher overall level of inflation than they have in prior economic cycles. And as a result of that, we do think that break-evens or inflation, you want to try and get some protection from. And so we do think that being long real rates is a very attractive way to do that. So the tips market, and in particular at the back end of the rates curve, we do think is an attractive own for a whole host of investors, in particular retail investors.
Mark Cabana, Bank of America Global Research, head of U.S. rate strategy. Good to see you. Good to see that trading room shot back as well. We'll talk to you soon.
Thank you.
Coming up, we're watching Tesla stock as the EV maker may be getting swept up into China's COVID challenges. We'll be right back. Welcome back. As we approach the opening bell on this Monday morning, we are also watching a few hot tickers on Yahoo Finance. First up, shares of VF Corp in focus after the North Face and Timberland maker slashed its profit outlook for the remainder of the year, citing weaker consumer demand across all brands. The company also announced the retirement of CEO Stephen Rendell and has named lead independent director Benno Dora as interim president and CEO. We'll get to the outlook in a second, but look, Benno, he was the longtime CEO of Clorox, one of my favorite CEOs. I've always appreciated his focus on, I think, the numbers of the company, product innovation. This might be the right guy at the right time just to get VF Corp, I think, going back on the right tracks, getting some margin improvement. I think Benno's going to spend his first few months digging into the business even more and plotting out the strategy for next year. Now, to that point, Steve Rendell, he was the one that spent a couple $1 billion to buy Supreme, very strong brand to bring into that portfolio. He has done top work. But again, the holiday season, at least for VF Corp, looks to have started below expectations. Never a good thing when this is only, early December, and you're already dropping your guidance as a retailer.
Yeah, I mean, the market doesn't seem to think that the new CEO is great.
Well, this is about the warning. I mean, they significantly cut the outlook.
Of course it is, yes. But you would think it is, but you would think it would be mitigated to some extent by, no?
No, the outlook is, they cut it big time. And the read here is, at least in my humble view, that they're going to enter the first quarter of next year with a lot of excess inventory. They're going to have to discount, and you're not looking at VF Corp really with a clean balance sheet into maybe spring, summer of next year. I mean, when you miss by 20, 30 cents on your guidance, I mean, that is a lot of stuff in the stores right now that just didn't sell.
Yeah, they said the promotional environment specifically here, and we've heard continuously about the promotional environment from some retail companies over the course of this earnings season, and some of them within their own outlooks have had to acknowledge how long of a tail that may have in terms of their own financial statements. And so with that, they said promotional environment, primarily in North America, and some of the lower volumes are expected to impact profitability in the near term.
And keep in mind, this is not just a VF thing. You're probably thinking, well, how is Ralph Lauren's holiday season? They're a key vendor into many stores. How is PVH doing? How is Tapestry doing? How are all these vendors into department stores doing in this promotional environment, like you mentioned, Brett?
Yeah, walk into Macy's and just look at all the deals that are taking place right now. And of course, in a highly promotional season, but a question of how much of that churn through inventory will also permeate over into next year too. We're also watching shares of Tesla this morning. TSLA, that's down pre-market by about 3%, following a report that the company is cutting production in its Shanghai factory. Yahoo Finance's Pras Subramanian tracking this story today, joining us now. Pras, what do we know so far?
Hey, Brett, how you doing, man? So, a bit of good news and bad news today for Tesla in China. Earlier today, they reported over 100,000 sales for the month, which is an all-time record for them. But like you said, reports coming from Bloomberg and Reuters talking about a production cut as well. They're reporting around a 20% cut that could take place as soon as this week. That would put Tesla down to around 80,000 vehicles a month for production capacity at Giga Shanghai, which is nothing to sneeze at. But the concern is that there's a demand slowing story there. We saw price cuts earlier this month. We saw them add some insurance incentives for buyers of new cars. So while these are happening, there's concern that demand lever is sort of slowing. And then also we see BYD, their competitor in China, with even more sales, over 100,000 EV sales alone, plus another 115,000 hybrids.
And let's broaden it out for a minute here, Pras, because we've got some notes that are starting to come in about the outlook for the automotive industry for next year. What are we hearing?
So today, JP Morgan came out with their European autos outlook for 2023. This is for the European automakers only. They see a better year ahead for next year. They see that the production, the supply chain snarls will ease, as well as cheaper materials costs for batteries and things like that. Their really high conviction stocks are Renault, Mercedes, and Stellantis. And Porsche is their top luxury pick for the automaker for the sector, following its IPO in the fall. On the supplier front, they like companies like Vitesco, tire maker Pirelli, and also parts maker Valeo, which makes OEM parts for BMW, among others.
Pras, if I ever need a book, I'm coming to your place.
Anytime, Saz, anytime.
I appreciate you.
All right, we got the opening bell here on this Monday morning. That's a normal amount of books.
There's a ton of books.
Got a lot of books.
I think it was on the history of the auto industry. I think his first book is on the Model T and Henry Ford.
I guess we talked to a lot of people who talked to us from in front of bookshelves.
A lot of books.
I don't know. Okay. Anyway, there's the opening bell on this Monday morning here. P10 ringing the opening bell. I guess it had its listing a year ago.
An exercise company?
No, apparently it's a private market solutions provider. I hadn't heard
Close,
it
close.
either. I hadn't heard. It does sound like a workout company, but it is not. All right, Brad Smith, as we see a downdraft here to start off the week, what are you seeing?
Yeah, P10 is actually a spinoff of Tony Perkis's exercise regimen there. All right, we're going to take a look at the major averages here. What, heavyweights? Nobody's watched the movie? All right, taking a look at the Dow Jones Industrial Average right now. It's lower by about 0.6% out of the gate here. NASDAQ Composite lower by about 0.6% as well here. And then the S&P 500, let me give you a chart view of just how we're looking over the past. We'll give you 5 days. Why not? Just to give you some of the activity that we'd seen last week, of course, on some of the Fed commentary, but then later on, yeah, you saw on Friday that move lower, and that coming off of the jobs data that came out in the monthly jobs report. But ultimately, here over the past 5 days, still holding on to some net gains of about 2% here. Also checking in on some of the sector activity out of the gate this morning. We've got the 11 S&P 500 sectors largely in negative territory right now. Energy, yeah, you're seeing that higher by about 1.25%. No doubt a lot of movement in the energy sector off of the OPEC news that we've been tracking, but ultimately the sector's still down by about 0.7%. It's consumer discretionary that's actually bringing up the caboose on the day. Right now it's down by about 1.4%. We've also got some negative movement in the way of real estate, and then as well, it looks like we've got some staples in negative territory too by about 1.2%. Julie?
All right, thanks, Brad. And let's talk about Activision Blizzard, too. It's in focus on reports that Microsoft is prepared to fight any attempts to block its $69 billion acquisition of the company if the U.S. Federal Trade Commission does indeed decide to file any lawsuits against the partnership. This reporting, according to Bloomberg. So interesting here because Microsoft hasn't always done this, right? Sometimes the feds come after its deals and says, okay, we're not going to do it. But this reporting says they're going to step up and try and make sure it happens.
It's good to see them fighting for this deal. It's a key transaction for Microsoft. I think a lot of folks on the street would like to see this deal get done. And look, Activision is a leading player in this industry, and Microsoft is the leading player with the Xbox. Makes sense.
It's also the number of jurisdictions that they have to get this deal approved within. They've had to get it greenlit and approved, greenlit and approved in Brazil. The European Commission was where some of their biggest hangups were. We had heard in a note from Bobby Kotick at the beginning of last month in a letter to employees that they were getting into the second phase of their review in that region. And it's really kind of bundled with where there still would be a competitive market, how that would ultimately still, even if this transaction continues to move forward and go through, that the consumer would not be impacted on the other end of this as well.
Yeah, the FTC is apparently getting to the later stages, as you said, of its investigation and its examination of this. And so we could find out soon whether indeed they're going to end up filing a lawsuit. Microsoft had said it planned to close the acquisition by June 30th. So there is still ample time in between now and then for the government to come in and say they don't want it to happen.
Yeah, all right. It's huge deal. We'll see if it ultimately gets through or continues to move forward. As of right now, looks decent. Guys, coming up, Yahoo Finance's Jared Blickreed. He's going to break down the latest market action to kick off the week. Welcome back to Yahoo Finance Live this morning, everyone. We've got major averages in the red right now to kick off a new trading week. Let's get more on today's tape with Yahoo Finance's Jared Blickery, who's over at the Wi-Fi Interactive. Jared, good to see you.
That's right, Brad. Beginning the week on a little bit of a downbeat here. Dow and the S&P 500 each off about 0.5%. The Nasdaq down about 1/3%. Just want to show you the 5-day price action so we can see kind of where we are. We had that big liftoff last Wednesday, and we've kind of been trading water here. Now, Friday, it seems like it was kind of a ho-hum day, but in the futures in the morning at 8:30 a.m., we got that big jobs print. Was a surprise to the upside, a bit hotter than expected. And guess what? Equities markets were able to claw back most of those losses. Pretty notable because if you take the last couple CPI reports, the S&P 500, the general market has been able to rally on those along with the jobs stat. We do in 2 weeks have this big Fed decision, and right before that we get another CPI reading. So that's going to be key. Here is the U.S. dollar index. The dollar has been controlling, or at least has been wagging the equities market for most of the year here. This is a 3-month chart, and you can see November was a big month of declines. Now we are sitting below the 200-day moving average. I'm starting to hear some rumblings, some questions on Twitter. Is this a false breakdown in the dollar and also a false break to the upside from its 200-day moving average in the S&P 500? Only a little bit of time it's going to take to resolve that. But Mike Wilson over at Morgan Stanley, who's been pretty on par, spot on par with some of the calls this year, has just said this rally needs to be sold. So if you're trying to navigate some of these twists and turns in the market, maybe we've gone a little bit too far too fast. Here we have energy in the forefront. OPEC Plus finally deciding that they're not going to do anything, not going to upset the apple cart. We were talking about that a little bit earlier. Energy up 1%. Aside from that, most of the sectors to the downside, trading to the downside, especially consumer ones, consumer staples, consumer discretionary. Those are each down more than 1%. So are the industrials. So let's take a look at the Dow stocks. Dow has been outperforming the Nasdaq recently, and today looks like the Nasdaq probably doing a little bit better. Apple on its side. Apple is up 1%. So is Chevron, IBM, but for the most part, looking at a lot of red here, guys, in the industrials.
Jared Blickery, thanks so much. Okay, today's stat of the day is 12. That's how many shared favorite stocks there are right now among large hedge funds, says the folks at Goldman Sachs. Some of these top hedge fund holdings include MasterCard, ServiceNow, Uber, Visa, Workday, and Wells Fargo.
That's not very many.
Well, I mean, I left the other ones out. I mean, they were less
12,
known names.
But 12 is not very many.
12 shared names among hedge funds. I mean, this is what this is set up. I'm just recording this. All right, coming up, we'll stay with the stock picks with our next guest. We'll be right back.
Concerns about weaker economic growth are mounting as investors weigh declining earnings estimates for 2023, plus the Fed's hiking path ahead of next week's FOMC meeting. Joining now to discuss is FL Putnam Chief Market Strategist Ellen Hazen. Ellen, it's good to see you. So obviously there's a lot weighing on investor sentiment right now going into the end of the year. We don't have much time left in 2022, but what kind of action are you expecting for the end of the year and then going into 2023?
Well, we expect to see continued volatility through the end of this year and frankly into the first quarter of next year as well. I think that the economic signals are so mixed right now, with some areas showing strength while other areas are showing weakness, that the market is ricocheting between optimism and pessimism. And I think you're going to see that continue until there's more clarity on the economic picture for next year and until there's more clarity for earnings for next year.
Why shouldn't an investor run away from a market where there is unclarity? At least at this point in time, there's still so many events that can take place between now and when there is firm footing to be found within your portfolio.
Well, we all know that over the long term, stocks return better than bonds and stocks return better than inflation. And trying to time that very precisely is very tricky and fraught with peril. And so we think you should stay invested. You can increase or decrease the investment a little bit, but you don't want to miss some of the big up days. Some of the biggest up days are right after some of the biggest down days. And it's very easy to miss those if you're trying to be too nimble in timing the market. So over the intermediate to long term, stocks remain a very good investment. And over the short term, we have to expect volatility and not overreact to that.
Ellen, what stocks do you like?
Well, we like stocks that have high free cash flow conversion, stocks that have decent dividends, and stocks that can grow in a slowing economy. Because whether or not there's a recession this year, the economy is going to be slowing. That's clear from many different indicators. So companies like Eaton, for example, Eaton is a company that's going to benefit dramatically from the Inflation Reduction Act and the grid build-out, trading at 20 times earnings, double-digit earnings growth, decent yield. We also like ADP. A little bit of an expensive stock. That's the big payroll company, of course. But that also has a decent yield and is growing earnings solid double digits. And then you barbell that with some cheaper stocks, like the banks, for example. Bank of America trading at around 10 times earnings, 2.5% yield. And then finally, you can also look at a healthcare company like CVS. Same thing, pretty good yield, pretty inexpensive stock. And so when you put that all together, you have some that are a little bit more levered to economic growth, but a big stable of companies that are going to go ahead and generate cash flow and dividends even in a slowing economic environment.
Ellen, I want to dig into ADP a little bit because I wonder if that pick is predicated on the job market not slowing that much, or ADP can still do well even if companies keep cutting jobs, for example.
That's a really good question, and it does hinge on the overall labor force and payroll numbers. So what's been really interesting is if you look at the number of job cuts that have been announced, it's been just as much offset by the new jobs created. And the fact is that the labor market is so tight right now that even when there are layoffs, you're seeing the jobs numbers continue strong. The labor force participation is a full point below the pre-COVID levels, and the unemployment rate is bouncing along between 3.5 and 3.7. And what that means is that even if there are big layoff announcements in some of the areas that, quite frankly, might have overbuilt during the COVID years, believing that those growth opportunities would remain forever, i.e. some of the big tech companies and the COVID beneficiaries, even if you see layoffs in those companies, you're seeing this be more than offset somewhere else. Now, as you note, if we have a hard recession and payrolls go significantly negative, ADP is going to suffer. But even then, it would be a short-term issue rather than a longer-term problematic company, very high-quality stock.
Ellen, won't the banks suffer, though, too? You mentioned you like Bank of America, but if we have a mild recession next year, it's obviously not good for lending. And now the Fed is back to cutting rates, which is not probably good for the margins on the banks, right?
So the banks have a lot of moving pieces, right? If you look at the net interest margin, which is one of the ways that they make their money, because rates have gone up and they haven't increased their deposit rates as much as Fed funds has gone up, their net interest margins have been expanding. And we expect that to continue throughout most of next year. So if and when the Fed does begin to cut, and it's not at all clear right now when that's going to happen. The market's pricing in April or May, but we think it may be later than that. Then their net interest margin will expand for a couple more quarters after that because of the lag, but then eventually it will come down. But given the valuation and the yield, I think there's still a lot of opportunity for a pretty inexpensive bank like Bank of America. And then on the credit side, that's the other risk, of course, with a recession. The banks are already assuming credit costs are going to go up next year. So I don't think that they will have significant negative earnings revisions because they're already expecting for credit costs to get worse.
Just lastly here, on the mindset of the consumer, where do you believe that, we actually will see at some point perhaps next year in the Fed's process a price stability or just kind of a price stable environment that consumers can count on for an extended period of time? And how much will the sentiment among consumers already be dampened within that?
So in other words, when is inflation going to top out and go back to 2%?
That's way better.
A really tough question.
Yes.
That's a really, really tough question. And I think that's the question everybody's focused on right now. If you break down the CPI, you do see that some components are beginning to roll over, right? You see some of the rents beginning to soften. And you see some of the goods areas of CPI beginning to soften. But the place that you don't see it yet is in services. And I think that's really tied to the wages and the unemployment and the payroll numbers. So as long as you have a tight labor supply, the services component, which is fundamentally a function of labor costs, that's going to continue to be higher. So we're expecting that inflation will continue to soften, particularly in those areas that are sensitive to interest rates. So housing, autos, things that you borrow for. And that will come down. But we do think that the services component is going to be the most sticky. And I'm not sure when it gets back to the Fed's 2% target.
Ellen, thanks so much. Good to catch up with you. FL Putnam Chief Market Strategist Ellen Hazen. And an update now. We were just talking about Tesla with our Pras Subramanian, and the company is now responding to those reports that said its production plant in Shanghai is cutting output of its Model Y this month. The EV maker calls this report untrue. Multiple reports, by the way, said the company's production was set to fall by over 20% versus November. Again, Tesla now says that is not the case. Coming up, Starbucks getting hit with the downgrade from Deutsche Bank. Saz is going to share his take on that next. Wall Street's getting more bearish on Starbucks. Deutsche Bank downgrading the stock this morning to a hold from a buy, warning that further gains will be hard to come by. That note caught the attention of our Mr. Brian Sozzi, and that's where we find his take today.
Here it is. So Deutsche Bank is out on Starbucks. I love that they say they're not positive or negative on Starbucks. They seem to be in the middle. So let me run through their call here. What they're saying on the stock, essentially, one, the stock is too pricey. And if you go to Starbucks statistics page, Yahoo Finance, you'll see that Starbucks trades for about 31 times forward earnings. That's almost two times the S&P 500. So a very expensive stock inside of a global growth slowdown and high inflation, you name it. So Deutsche Bank might be right on that regard. Next up, the easy money has been made for now. Starbucks shares pretty much have been on a straight line up since the latter part of the summer. Of course, a lot of that is optimism around Howard Schultz turning around the company, running a better, more efficient operation. Now, he will, at some point, no longer be CEO. He will hand that off to his handpicked successor, but nonetheless, some of that optimism now priced into Starbucks shares. What Deutsche Bank does mention, some key risks to Starbucks in 2023 that all investors need to pay attention to, especially for a stock that is priced for protection like a Starbucks. First, U.S. economic slowdown intensifies key risk. If that happens, people not buying as much coffee, maybe they just go there in the morning, they don't go back in the afternoon. China performance is a crapshoot at this point for Starbucks. They operate thousands of stores in China. And while they may be having a good U.S. holiday season, Deutsche Bank says that risk to the China business is very real. And if they do not do well in China, they are unlikely to have a very good couple quarters. And lastly, still rising interest rates, usually a problem for all high multiple stocks. And of course, as I just mentioned, Starbucks fits that bill as well. My take overall here, and just even I have to pull out my affinity for the Trenta-sized iced coffee, and that's a hot coffee with my face on it. I'm going to take that photo and put it on LinkedIn. I absolutely love it. But this call makes sense to me, despite my love for that coffee. This is an expensive stock in a market that is just not liking expensive stocks.
Yeah, I mean, for Starbucks, the growth that you were talking about a moment ago that they had banked on and brought up quarter after quarter was around China, was around their digital consumer and the touch points that they have there, and being able to sell further into that digital consumer as well. And, of course, the number of stores that they were looking to bring online in China at a time where Luckin Coffee was really taken out. I mean, we've seen what happened with Luckin Coffee.
Yeah, unrelated to any of this, I saw a LinkedIn post over the weekend. Dunkin' Donuts just opened its 20th store in Switzerland. So I didn't realize they had stores in Switzerland. Now they have 20 of them.
That is
wild, right?
Surprising. I wonder how many Starbucks there are in Switzerland.
I don't know.
We got to get over there and check it out. Boots on the ground reporting. We've got that hopefully coming to you. We got to get it approved and the spend too. But from here in the studio, at least for now, coming up, we're going to take a closer look at a company of the year, Costco, with analysts from Cowen and D.A. Davidson. That's coming up next.
Welcome back to Yahoo Finance on this Monday morning. I'm Brian Sozzi here with Julie Hyman and Brad Smith. We're seeing some continued profit taking despite positive signs on the reopening of China's economy. Right now, we're seeing all three major indices in the red. Now, here's what's on tap this hour. About that wrong call in crypto, Shark Tank's Kevin O'Leary stops by to share his thoughts on the downfall of FTX, a company he did in fact do business with. A cybersecurity outlook. The CEO of CrowdStrike, George Kurtz, will join us on the heels of a more cautious outlook than Wall Street expected last week. And Costco takes home the crown. Costco is Yahoo Finance's Company of the Year. We'll have my chat with Costco CEO Craig Jelinek a little later on in the show. Brad, I had my first Costco hot dog with Craig last week. Damn, is that thing good?
It was good.
It's good.
Okay. Condiments, did you put that on it too?
No, I was just so excited. I just ate the whole thing.
Okay. Well, maybe we'll get some. Craig's got to send some to us here in studio. Maybe we'll try them out on set. Guys, let's take a look at the Dow Jones Industrial Average as we are 30 minutes almost into today's trading activity on a fresh trading week. We've got the S&P 500 actually up on screen for you right now. We're down by about 0.9%. Dow Jones Industrial Average, that's down by about 0.8% right now, 270-ish points in the red. And the tech-heavy NASDAQ, you're also seeing that in negative territory right now by about 0.7%. I wanted to zero in on first the sectors. We'll go there and then we'll come back to this other board that I have set up for us in our convenience. We've actually got just one leader on the day right now. That is communication services. That's flat, just barely to the upside. However, bringing up the caboose on the 11 S&P 500 sectors, you've got consumer discretionary down by about 1.8%. And then also, you've got a little bit of financial movement lower here by about 1.4%. But getting back to some of those travel names that I had pulled up a moment ago, and particularly on one call from Morgan Stanley saying that 2023 may be a Goldilocks year for travel. That kind of echoes some of the sentiment that we've heard from some of the other travel CEOs that have talked about, in Hilton's case, a golden age of travel that we may be entering into, or even from the airline front, what they've been seeing in surging travel demand. UAL is up on that call from Morgan Stanley. We're seeing that up by about 1.4%, as well as some of the other airlines names holding on to some gains, at least right now. So we'll continue to watch that. However, getting back to retail, we announced our company of the year today. It is Costco. Despite the stock taking a hit year to date, the warehouse giant aided consumers in a year of record inflation and saw sales rise 16% for its fiscal year ending in October. For more on the state of Costco, we're joined by D.A. Davidson, Senior Research Analyst Michael Baker, and Cowen, Senior Research Analyst Oliver Chen. Great to have you both here with us today. Oliver, I want to start off with you. When you think about what year this has been, what a year it has been, especially for consumers who are looking for deals and perhaps buying in bulk, the name Costco alone that stands out among this broader consumer environment right now?
Yeah, Brad, great to be here. Happy holidays, everybody. Costco screams value, treasure hunt, that $4.99 rotisserie chicken. I'm wearing Costco jewelry. It's a really unique business model, and being a member there enables you to buy goods at lower prices available than anywhere else. It's a fixed low markup model. So you're getting a great deal no matter what. And Kirkland's an iconic brand too. So it checks many boxes for us. We have more than ever before a consumer looking for value. It's one of the few global concepts that the US has exported. And also it's a net cash dividend yield, free cash flow yield is attractive as well. All these things make for a great story in our opinion. The one disclaimer is the PE is 30 times. That's a fairly expensive stock. However, we think it's worth it given what I mentioned.
Michael, I talked to CEO Craig Jelinek as part of this Yahoo Finance Company of the Year package, and he said that he is seeing some signs of a recession, a slowdown in jewelry, a slowdown in TVs. How do you think a stock like Costco will perform next year if we do in fact get a mild recession?
Well, yeah, and I think we're starting to see that creep into the sales a little bit with the last few months being strong, certainly relative to most retailers, but slowing a little bit for Costco. And as it relates to next year, you know, if we do go into a recession, we do think consumers will continue to shop at Costco, and we think their sales will hold up better. As it relates to the stock, I think the key question, and Oliver touched on this, and we agree with him, would depend a little bit on where the valuation is at that point. If the stock continues to come in a little bit and starts 2023 at a little bit more of an attractive valuation, if it does outperform on the top line, at least in an environment of slowing consumer spending, there could be a case to be made for the stock. But we'd like to see the valuation still come in a little bit from here.
Oliver, just to take a little bit of a backtrack, I don't think I've ever heard anyone say I'm wearing Costco jewelry right now. And I got to say, you're one of the best dressed analysts I know. So I'm assured that it is nice looking jewelry. But I am curious, when we talk about the coming economic environment, in past economic pullbacks, do you have people who say, yes, I know Costco has things that are lower priced, but I don't want to pay the membership fee, for example? Do you have some attrition of members in economic periods like this?
Yeah, Julie, we're impressed with the renewal rates. They've been at 92%. And membership growth has also been impressive, above 5%. So those are key statistics that give us a lot of conviction. Also, Julie, we have higher income consumers trading down to Costco, and Costco is well positioned with household income above other retailers as well. So those are two dynamics that work really well, and everybody loves a good value. It's noteworthy that Costco only has about 3,000 to 4,000 items. So best of class across cashews, pearls, gold jewelry as well. You can really trust that their merchants have done a good job. And this is a key core competency, being one of the biggest buyers of many categories. That's another positive too. And consumers will be looking for value, having this clarity of value. And don't forget, there's a treasure hunt experience in store. Consumers are going back to stores. That's a positive trend too. One of the big problems in retail has been negative traffic across the industry. Costco has distinguished itself by having positive traffic and positive momentum. That's very hard to get in this age of digital. And Costco's digital online products getting better and better as well.
Michael, one of the other major categories that everyone, Costco, Sam's Club, BJ's, they all compete on is the rewards that they give some of their members, especially in a time where they might be experiencing higher gas prices even. How much does that continue to be a competitive play that they continue to roll out even going into 2023, or even just as some of those gas prices start to abate a little bit?
Yeah, well, gas has been a huge story for all the warehouse clubs this year, BJ's and Sam's included, and we think certainly remains a positive for Costco. There is some risk, though, that if gas prices do continue to moderate, that'll be less of a positive catalyst going forward because it's been such a strong catalyst in 2022, and they've made not only great top line growth from there, but also great profits on their gas business. And so there is the concern that gas profit windfall might not repeat to the same extent next year and could end up being a little bit of a margin drag. Now, typically, I think analysts exclude the gas price benefit from the top line trends, but it is harder to disaggregate from the profitability. Again, one of the things that has led to really strong profitability this year might be a little bit less so next year.
Oliver, is the Kirkland brand you mentioned, is that this company's secret weapon? And I bring this up because longtime CFO Richard Galanti told us last year, for the fiscal year ended, they racked up about $50 billion in sales related to Kirkland alone. I mean, that's huge. It blew me away.
Yeah, Brian, the name of the game in retail is differentiated private label because you can get only Kirkland at Costco, and Kirkland has very powerful brand equity, in our opinion. I even bought a Kirkland sweatshirt. Thinking about Kirkland, it really stands for quality and it stands for great pricing again, and it cuts across many categories. So it's a unique private label in that you can buy a sweatshirt, you can buy Kirkland Chardonnay, you can buy Kirkland chicken, many categories, which is quite unique too. What they've done is use private label strategically. Costco has a mixture of national brands as well as Kirkland. And it helps them get better deals as well on national brands. And it also really highlights Costco's ability to innovate product and offer you a great product at a great price that's well trusted as well. So lots of features, but the bottom line is the future of retail is offering proprietary private label as well. And Kirkland checks that box as well.
Next thing, Oliver, you'll be telling us your suit is from Costco also. No, just kidding. Michael, one of the things that you point out in your latest note is, and we saw this big time, especially earlier this year, how much gasoline was driving traffic to Costco because of the differentiation that Costco offered on that front in terms of price. Gas prices have been coming down everywhere, right? So is that less of a traffic driver for Costco now?
Yeah, I think it probably will be. So still a great deal on gas at all the clubs, but maybe a little bit less of that panic buying that we saw back in February, March, and April, and even into June when gas prices peaked at more than $5 a gallon. We'd go to Costco and see lines. It felt like the early 70s in terms of people lining up to get gas. Still see a lot of people at the pump these days, but a little bit less so than we saw over the summer. And some high percent of those customers, it's in the 30 to even 50% range. When they go to fill up at the tank, they go into the store and pick up some items while we're there. So, with all things Costco, it's still a positive, but maybe a little bit less of a positive than it was at the peak of this gas price situation earlier this summer.
All right, very helpful deep dive into our company of the year, Costco. D.A. Davidson Senior Research Analyst Michael Baker and Cowen Senior Research Analyst Oliver Chen. Thanks, gents. Appreciate it. All right, before we head to break, we continue to monitor shares of Apple as it deals with manufacturing challenges out of China. Evercore ISI analyst Amit Dariani says he still sees 30% upside in Apple stock, but adds a note of caution in a new piece of client research. Says the analyst, although we note that demand has remained strong and demand destruction has been minimal, there's a possibility that the situation in China getting worse negatively impacts consumer demand. Coming up, Credit Suisse's new investment bank may be getting a surprising investor. Julie is back with a look at today's top headlines next.
Let's get down to business now and check in on some of the other headlines that we are watching. Saudi Arabia's crown prince reportedly considering investing in Credit Suisse's new investment bank. The Saudi prince potentially putting in approximately $500 million to back that new unit, CS First Boston, and its CEO designate, Michael Klein. Other investors at play may also reportedly include Bob Diamond's Atlas Merchant Capital. Those Credit Suisse shares here in the U.S. up by 5.5%. New Zealand is seeking to make online platforms such as Google and Facebook pay news publishers for content. New Zealand's proposal will be designed to act as an incentive for voluntary deals between digital platforms and local news outlets, allowing for platforms like Google and Facebook to negotiate with publishers without government intervention. However, the law would plot out a mandatory negotiating process in the case of no agreement being reached. And Delta Airlines is offering pilots a 34% raise over the term of a proposed deal that's pending approval. The proposal includes an 18% raise when the deal is signed, followed by 3 further pay increases in subsequent years. In addition, pay rates for Delta pilots would exceed those at United and American Airlines by at least 1%. Saz?
All right, let's head over to Yahoo Finance contributor Kevin Cirilli, see what DC is looking forward to start this week. Kevin.
As we've got the runoff election in the Senate between Raphael Warnock and Herschel. And look, I think the biggest question right now is if Democrats are able to win this seat, it would be essentially that Georgia's trending much more Democratic, similarly to what happened in Virginia back in 2008. It was always perceived as a battleground, but if Democrats are able to hold on to this, clearly a sign that this is moving in to the left. In contrast to that, if Republicans squeak this out, that's going to be some much needed good news for the far right movement, the MAGA movement of the Republican Party. So a lot of potential gleaning from the information on what happens down there in Georgia.
And turning to the National Defense Authorization Act, GOP lawmakers, they're looking to play hardball. What can you tell us there?
Well, the NDAA is worth about $850 billion, even a little bit more when you tack in some energy the pieces of components to it. And Republicans are suggesting that they want to have no more mandates for vaccinations for the military. Now, likely new Speaker of the House, Kevin McCarthy, spoke about this directly with President Biden, reportedly. In contrast to that, Democrats want to include some diversity and inclusion language into this piece of legislation. It's ultimately going to get passed, but it is the last major piece of legislation that needs to get done ahead of the December 16th deadline to pass a government funding bill. But there's another component of this, just quickly, which is they could tack on bipartisan legislation, the Safe Banking Act it's called, which would allow for cannabis banking financial services. Remember, marijuana is still listed by the Department of Justice as a classified as a drug up there with like LSD. And so while 20 states plus the District of Columbia have legalized recreational marijuana use, the banking for that has not caught up. So the regulatory structure for this industry could take a giant step forward, even ahead of DOJ in this lame duck session.
Yeah, and we've seen some of the cannabis stocks moving on anticipation of that potentially. And finally, Kevin, President Biden paying a visit to TSMC, Taiwan Semiconductor's Arizona chip plant that's currently under construction. So there's some focus there.
There is a lot of focus in high-tech innovation and manufacturing. He'll be accompanied by Secretary of Commerce Gina Raimondo. Remember, she was instrumental in pushing that Bipartisan CHIPS Act over the finish line, which allows for there to be significant investment here domestically in the United States, retraining the workforce to provide high-tech innovation jobs for semiconductor chip manufacturing. TSMC breaking ground on that plant that dates back to the previous administration. Remember, TSMC controls something like half of the global supply of those semiconductor chips, obviously headquartered in Taiwan. A lot of geopolitics. Separately from that, what's happening this week is that EU and US trade officials are talking about technology. And we saw this with French President Emmanuel Macron over the weekend in his interview on 60 Minutes, where he said that he's talked about subsidies for electric vehicles, the tech in EVs, really at the forefront of the conversation for the EU and US tech trade officials. So a lot happening on the tech diplomacy front this week. And mind you, while all of this is happening in the West with NATO allies and obviously strengthening supply chains with TSMC, guess where Xi Jinping is? He's meeting with Saudi officials.
Yahoo Finance contributor Kevin Cirilli, thanks so much.
Thank you.
Coming up, Costco is this year's Yahoo Finance Company of the Year. We'll have my chat with Costco CEO Craig Jelinek next. Yahoo Finance's Company of the Year for 2022 is Costco. I had a chance to sit down with Costco CEO Craig Jelinek to take a look back at the company's performance this year.
Never gets old. It never gets old. Now, I remember when we opened up the 6th location, we certainly didn't do much volume. I think we had a $150,000 day, and normally we do that in a lot of new openings every hour. So, you know, it doesn't get old. You get to see the customers, you get to see our employees, and it creates opportunity for our employees. I love it.
What is it like? This is a huge store, 50,000 square feet?
This one's about 160.
160. What is it like to open a store like this?
Well, I mean, it takes a lot of work. Obviously we're very good at it now because we've opened up a lot of Costco's. In a market like this, all of our employees come from transfer, create more opportunities. So we have a lot of long-term employees in here. So it's relatively a smooth operation as long as we can get the goods, we get the construction done. It's an easy operation to open up.
So Craig, you won the coveted Yahoo Finance Company of the Year award. We really give it out to those companies that are best-in-class operators in a given year, and certainly Costco delivering all those marks.
And I really appreciate that, but I got to tell you, this goes to all the people in the organization. They truly are what makes this company go, and I'm very blessed and fortunate just to be part of it. So I really owe it all to them. But it's been really a long 3 years. When you started with, it's kind of like COVID started, and then it's been a hangover from COVID for, I think, the last 3 years in terms of challenges with getting merchandise, keeping your employees safe, keeping your members safe. So it's been a tough 3 years for everybody, for the country. And I think you continue to have a little bit of hangover from all the things that's transpired. But, we've persevered, and we're very pleased that we've been able to get merchandise and continue to create value for our members and grow our membership base and drive sales.
Is it that consumers are trading down from grocery stores in an environment where inflation has been through the roof? Eggs, butter, toothpaste, you name it. Are you in fact the low price leader in most of these categories?
Well, we believe that we are. Now, I'm sure others out there believe that they are. The proof is what the consumer says. And we believe we're the low price leader. Our markup's about 13%. So, any rebate money we get, we pass right on to the consumer. We're a top line company. We drive sales. We're not a margin company.
Any signs from all the data you are collecting right now that we are past the worst in inflation in this country?
There's a couple ways to look at that. I don't know we're past the worst. I believe we are. I felt that we are for the last 2 or 3 months, because at some point when you start to see container costs coming from Asia, I think in non-food, the container costs are starting to bring prices down because transportation is starting to come down. There's still a shortage of things like eggs. I don't see the egg market deflating at the moment.
Well, there goes my breakfast, Craig. Thank you. Appreciate it.
So I think there'll be some consumables there may be a problem, but I think overall you'll start to see some decrease in deflation, I should say.
Your read on the holiday season so far?
I was very concerned about November. After Thanksgiving, I think things are going to be a little bit better than we thought.
Do you see consumers pulling back at all? Are they still? I was walking the store. I saw a $2,000 bottle of wine. I saw you selling electric bikes for $3,000. Are those moving in this environment?
Yes, they are.
They are.
They are moving. But it's a certain economic class where things are moving.
So you cater to the higher end consumer?
Well, we think we do. Yes, we do.
So you mentioned workers a couple times, and Costco has long gotten really high marks on its employees, how it treats them, how it pays those workers. Where did that come from?
Well, I think that came from really our founders, Jim Sinegal, Jeff Brotman. You want to have a good company, you need good people, you have to pay good wages, and you have to build loyalty. And we don't have much of a turnover in our organization. So we want people to stay long term. We want people to make higher wages. We want people to be able to afford homes. It's just the right thing to do.
The economy in November created 263,000 jobs. Everybody was looking for a slowdown, didn't get it. Can you find the workers you need to open stores like this?
We can find the workers we need. They're probably a little bit less experienced in the workforce than what we would like to have, but you can find workers. It's not as easy as it was, say, 10 years ago. It's a much different environment. More people, I think, like jobs where they can work from home. This is a business that you cannot work from home.
A lot of your competitors in retail, Walmart, Target, you name it, they've now invested a lot in higher wages for their employees. Do you feel like you have to make a new investment in your employees to take those wages even higher to just, I guess, reestablish that gap with them?
We always want to make sure that our employees are at the higher end of the scale, and we believe that they are at the top end. Of course, that starting wage is narrowed for everybody, but we want to also pay for longevity. We do not want to turn people. We want to keep our employees.
Do you see any signs of recession in the United States?
You know, a little bit. I think, especially when you look at things like, jewelry, our jewelry business has slowed down. If you look at the really high-end television sets, they've slowed down. Unless you start to take some markdowns on some goods, you'll see the TV start to move. So I think right now people are very, they're always value conscious, but I think more so now than ever.
So let's do a little quick around the horn. Your favorite Kirkland product?
Kirkland, whether it's a combination between the white cake and the hot dog.
The one competitor that keeps you up at night?
I think all competitors keep you up at night, to tell you the truth. But what you got to worry about is how you run your business. That's what you have to worry about the most. Competitors, fine, but you have to figure out and do what's best for your business. Take care of your member, take care of your employees, continue to figure out how to create value, and that will take care of itself.
Charlie Munger, big fan of Costco, on your board, a shareholder. He's said this once, this quote, "I wish everything else in America was working as well as Costco does. Think what a blessing that would be for us all." Any funny Charlie Munger moments you can share?
I could share many with Charlie. Charlie's got a photographic memory. He says it just takes him a little bit longer to get it printed.
Fair enough. Recently, too, something that caught my team's eyes, that you promoted Ron Vacris. Succession, next Costco CEO? What can you tell us, Greg?
Let's put it this way. He's president, and we'll let it go at that.
How long do you see yourself as Costco CEO?
For a while.
For a while. Okay. Well, I can read between the lines. Two more for you. Next 10 years at Costco, where do you think this brand goes?
We'll continue to expand. We think over the next 10 years, God willing, we could double the size of the company, and we'll focus a lot more on international.
As you reflect back on your career, your biggest achievement in your view?
I don't get too caught up in achievements. I think I was very blessed to be able to be the second CEO of this company after Jim Sinegal, and I think we've moved the company forward. So I just consider that I had some big shoes to fill, and I think as a team we've done pretty good in moving the company forward over the last 12 years.
Craig Jelinek, it has been a pleasure to follow your career. Costco CEO, let's maybe go out and buy one of those 93-inch plush bears?
You should.
All right.
They're a very hot item.
My brother would kill me if I bought that for my niece for the holiday season. There's nowhere to put it, Craig. There's nowhere to put it.
I bought one for my grandkids, right? And the first time we had it was over in Australia, and I flew it back from Australia. Great item. That's probably one of the craziest things I've done.
Those bears are 93. They're huge, and they're $3. It's just a big product. But look, very interesting what Craig said there about succession. And what you don't see here, I got to spend a couple minutes with Ron Vacris. He was promoted, like Craig mentioned, to president earlier this year. He was walking the store floor. I had maybe 2 or 3 minutes with him, just caught up with him briefly. That is very likely to be the next CEO of Costco. Whether it happens early next year or within the next year, it's probably likely to happen within the next 2 years. Ron has the key DNA that all Costco CEOs have had, and Craig is the second one. He's a merchant. He started at this company early 90s, came over with the merger of Price Club and Costco, strong merchant, and that's how Costco picks its CEOs.
I loved your call out of Price Club, the mention of that background.
That was a game changer.
Right on.
Remember Price Club?
I remember Price Club.
Yes.
That's going back to the very early days of these kinds of warehouse clubs. I mean, you get such an old school vibe, right, from an executive like that. but it's worked for them.
This guy, he wasn't doing it for the cameras. He was walking the whole store, greeting employees, checking out the merchandise, and CFO Richard Galanti was doing the same thing. Over the past month, they've had, I think, maybe 4 to 7 store openings. He's been pretty much at all of them, walking the floors. I mean, he's been the CEO for 12 years. It's just in their blood. It's just a different company. I bet any other retailer could be opening up stores today. Let's say Dollar Tree, Dollar General. CEO's not there walking the store.
Well, the stat that he mentioned, too, was astounding. $150,000 an hour is what they're used to doing on some store openings. And that goes to the strength of the brand, the number of consumers that perhaps are waiting for them to open up. Because, yeah, you see the store getting constructed, and now that builds up enough of that word of mouth traffic in a local region to say, hey, we got a Costco that's on the way. We're ready to sign up in advance in order to be able to take advantage of this on day one.
One final thing. It was amazing to see. So this Costco was really in the middle of nowhere. Dark road, and plop, they put a Costco. Store open, nice crowd, but within about 2 hours, this place was mobbed. It was just absolutely packed. It felt like Costco on the weekend.
Real question is, do you have to buy an extra seat for the teddy bear if you fly it on the plane, like Craig was saying?
2 seats. I think it's huge. It's 93 inches. Jesus. It's giant. It's huge. I would have nowhere to put it.
That's taking up some space. Yeah. Guys, coming up, addressing the damage from the FTX fallout. We are speaking with Mr. Wonderful himself, Kevin O'Leary, on a situation that is anything but. His take on the downfall and how he feels about the crypto space. That's all coming up next. Welcome back, everyone. Checking in on tech. Despite seeing a vast acceleration during the pandemic, the boom had been gathering pace for years. The so-called FANG stocks were already outpacing major benchmarks long before COVID-19 arrived. Then a bucket load of easy money came fresh and gave fresh momentum to plays like Zoom, Uber, and DoorDash. But with any tech boom comes pressure and turnover, from the likes of Adam Neumann to Travis Kalanick. We've seen this movie before over the years. Yahoo Finance's Alexandra Semenova will be taking a closer look in a new series. Alex, what can you tell us?
Well, Brad, there's been a lot of talk of the pandemic era boom and bust, and rightfully so, because we've seen so many companies just explode last year. We've seen a lot of new businesses emerge. And then, of course, as the Federal Reserve began its tightening campaign, we're watching it all go downhill for many of these businesses. But another interesting component of this boom and bust stories is the business leaders behind these companies, leaders that we've seen on the covers of magazines, leaders that we've seen praised for their success as they rode this pandemic boom, are now watching it go downhill downhill. Sam Bankman-Fried and FTX are, of course, the most abrupt example of this. But there are a lot of names in the space who haven't been accused of fraud or any wrongdoing, but, maybe made really bad bets that investors are now paying for. And even though there's no criminality for many of them, there are comparisons to be drawn. It's overzealousness, it's corporate greed, poor investments, and then on the part of investors, lack of proper due diligence as they rush to allocate capital. So this series is going to explore that and how the era of free money contributed to that.
All right, great series. We're going to be looking forward to that. Alexandra is going to stay with us for this next conversation here as we take a look at crypto assets this morning. Bitcoin, yeah, that's currently up just a little bit, and you're seeing Ether, FTX token, Binance, Solana also higher as of right now. But this is all as the fallout from the collapse of FTX continues. And since crypto lender BlockFi filed for Chapter 11 bankruptcy protection last week, the company and the question now that many are asking is how widespread could the contagion be? High-profile interviews by embattled founder and former CEO of FTX, Sam Bankman-Fried, have furthered the debate on whether he knowingly commingled funds. He says he didn't, and that seems to be a view supported by our next guest. We're joined now by Mr. Wonderful himself, Kevin O'Leary. Kevin is the chairman of O'Leary Ventures, but you'll know him better as the co-host of Shark Tank. Kevin, also an investor in FTX, as well as a spokesperson for the exchange. Kevin, it's always a pleasure to grab some of your time here. Help us make sense of all this, first and foremost. When you think about what has taken place with FTX and what we've heard from Sam Bankman-Fried to this point, do you believe that he committed fraud or misled over that time?
The answer is I don't know yet, and I've said that from the beginning. The point is we don't have any facts. We have a lot of hysteria. We have an angry mob crowd. We have a lot of conjecture. We have a whole lot of stipulations that no one can basically has any basis to make claims on. And my problem, and the way I'd like to deal with it, and the way I'm going to deal with it is, look, for full disclosure, I'm a shareholder in FTX International, a shareholder in FTX US, and I have corporate accounts on the FTX platform. Here's how I'm going to deal with this. I want full transparency of every transaction in my account, which has been swept clean. Millions of dollars are missing. There is no accounting records there. There's no conversion records. There's nothing. Now, when this occurred was middle of Saturday afternoon 2 weeks ago, when the company filed for bankruptcy in 101 locations plus. And so somebody is controlling that server. And for the sake of all of us as institutional investors who require this data for our taxes, for our compliance, for our accounting, for our reconciliation, we need the servers turned back on so we can see this information. I'm not saying open the exchange or operate it. I don't care about that. What I care about is being able to forensically audit every single transaction that occurred in my account. And then we'll have the answer of who did what and where and when, because one of the remarkable situations about this financial collapse, different to Enron, different to Lehman Brothers, different to Bear Stearns, is that 90+% of these transactions are on chain. Mm-hmm. They are irrevocable. They cannot be changed. They're on the public record forever, probably on AWS servers right now. In addition to every dollar wired into those accounts, whether they be SWIFT or Fed wires or ACH transfers, that's all reconcilable. So by the time this is over, and you ask me what Sam Bankman-Fried did, we'll know. It'll be totally transparent. And until then, I'm not joining the herd. I'm just waiting for the facts. That's what I'm doing.
Kevin, thank you so much for being here. I wanted to get to something that I think a lot of people have been wondering about and maybe even taken a bit aback by. After that interview at DealBook last week, you reposted a tweet from Bill Ackman, essentially agreeing that you believe SBF when he says that he didn't knowingly commit any wrongdoing. I guess I wonder what has you still coming to his defense when you've lost millions of dollars on this investment and when so many people have lost money here?
Because I am of the ilk and the, of the group of people that says you're innocent till proven guilty. That's what I believe. And I want the facts. And so if you tell me that you did or didn't do something, I'm going to believe you until I find out it's a falsehood. What we have now is everybody on earth raging against this guy, Sam Bankman-Fried, saying he's a fraudster, he stole the money, he took it to his own account, it's hidden somewhere. How does anybody know that if we have no way to audit it? How can anybody make that claim? Are they not as baseless as what Sam Bankman-Fried is saying until we have the facts? That's all I'm saying. And I think Ackman's in the same camp. I want the facts. That's all. I don't think that's asking too much. And frankly, I can't retrieve my money until I know where it is. And that's the first thing I need to know. I need to know, where was my money transferred to? It's alleged it went to the Bahamian government, alleged it went to the US, alleged it was stolen in a hack. I don't know any of that yet. And I want to know where it is, because I've told all of my lawyers, keep your phasers on stun until we have facts. Then we're going to get that money back. That's exactly what's going to happen. I'm not the only institution in this situation. We all want our recovery path. We need a recovery path, but we don't have one.
Kevin, yeah, there is a lot still to be explored here, but what would you say to the people who are not seeing their money right now, the people who have invested their savings into this company who now don't know where that money is?
I'm one of them. That's exactly what happened to me, and I intend to fix it. I'm going to go after that money. I want it back. I have the resources to do it. I'm very fortunate. I have millions of followers. I'm going to take them on the journey. I'm going to get the money back. That's what's going to happen. And where the chips fall, I have no idea. Who's going to jail? I have no idea. Who was fraudulent? I have no idea. But I will find out. I can tell you that, because this is 100% auditable. 100%. I don't care if it takes 3, 4, 5, 6, 7 years. Doesn't matter to me. You can't take my money and expect me to do nothing. I go after it, just as other institutions will do the same thing. Every lawyer and his dog is going after this thing right now, trying to figure out what happened, but we don't know anything yet. So why don't we just get the facts first? And if Sam Bankman-Fried can shine light on the facts, because from what I understand, he's been kicked out of the company, he has no access to even his emails, he has no information past the moment the company went into Chapter 11. So he's one piece of the puzzle. But we also have to talk to those that are going to go through the bankruptcy process. And that's the same team that did Enron. And what I want from them is total transparency on everything, including I want access to my account and all the information there. And we have regulators all around the world pursuing that same information. Before this is over, I'll be able to, in my own team, reconstruct every single transaction that occurred, because you can't take it off the blockchain, and I'll have access by the time I finish litigating to every transfer that was a SWIFT, an ACH, or a Fed wire. That's my assumption.
Right.
And that's the only way to do this. It's the only way to do it. And lastly, from the people doing the bankruptcy, I would like total transparency on the fees they're charging. That's my money they're spending, and other institutions' money. I want a website set up that gives us that information. We know who's getting paid, why, and when. As I understand it, $700 million got extracted from shareholders of Enron or claim stakers of Enron to bankruptcy proceedings. That seems a little high to me in this case when we have the audit trail of the blockchain.
Right. Kevin, we've also heard from Elon Musk via Twitter, because where else, saying SBF was bad at league, enough said. Somebody else saying that we don't need to hear any more, or there doesn't need to be any more mentioning about SBF except for his court date. Elon Musk then responding, let's just give him an adult timeout in the big house and move on. Do you believe that SBF will, at the end of this, serve time for the mishandling and perhaps, if proven, the fraud as well that's taken place?
I have no idea. The audit will determine it. The transfer of capital that will be dollar by dollar audited, and we will know all of that. And if there was nefarious activity, if he did break the law or anybody else in there broke the law, they'll face the full force of the law, because there's a lot of people that are not happy about this, and I'm one of them. On the other hand, we're in a society that assumes guilt until proven guilty. So I don't know how Elon knows. If I don't know, how does he know? Nobody knows. I've asked every institution, do you have any idea where your capital went? The answer is no. So until we have information, until we have the facts, until we have the audit trail, until we have the conversions out of the account, until the accounts are open for scrutiny, nobody knows anything. And so it's all speculation. Now, the story itself is not going to go away. This story is not just a financial collapse. It's a human story. How did this happen? How can some of the largest financial institutions on earth have got into this deal? We all have egg on our faces. We're all embarrassed. We all feel foolish. But at the same time, It's not over. We got to figure out what happened here so that A, we can regulate against this ever happening again. What is the, we should have regulated this exchange no different than the NASDAQ or the New York Stock Exchange or any other exchange that's regulated. Put all the safeguards in. And I think that's going to happen. If there's any silver lining in this story, it has to be that. Regulators have woken up. The Hill has woken up. Washington's woken up. Everybody's talking about this disaster.
Right.
And we're going to talk about it until we get all the facts. Sam Bankman-Fried is going to be on Twitter every single day for years to come while we unpeel this onion and find out what happened.
Kevin, while we have you, and we got to hustle to our finish here, but earlier this year you told me that you were maxed out in crypto investments and representing about 20% of your portfolio at that time. Where does your crypto exposure stand right now?
I had the same positions on. Obviously, it's down significantly because we've had such a correction across all asset classes. And I'm probably sitting right now at about 14.5. We just marked to market today. We've had to take some big hits like everybody else. We're looking at doing some sell-offs for tax purposes because this year we will be reporting taxes on all crypto positions as just started last year. Here's something else to think about that, and I've had this conversation with countless institutions. There is such a close correlation between 5 different tokens and level 1, level 2 chains that you don't need to own 30. You can own 5 or 6 and get the same volatility that the 10,000s token give you. So what's going to happen here over the next 36 months, in my opinion, and I'm going to remain, this doesn't change anything in terms of what I do in crypto. I'm going to continue to invest, but I obviously have to concern myself with tax wash selling. So if I sell my Bitcoin here, I've got to wait at least 31 days to reposition myself, and I will do that. But I don't need to buy 30 positions anymore because it's clear, given what happened, the correlation is so tight. So I predict tremendous pressure on tokens that have no utility, no value, no merit, no use, no app. They're all going to go away. And so what we're going to get is a much cleaner, a much more correlated, a much more productive crypto environment. And much of it will accrue to the big platforms, Ethereum and Bitcoin, probably Polygon, which makes Ethereum more efficient. But you really don't need much more than that. And that's what I think you're going to see happen to this sector, a very tight correlation to just a few names. However, if we get regulation, particularly around stablecoins, it will bring a lot more capital into the space into a lot fewer names.
Kevin, as we mentioned at the outset, appreciate getting some of your time. I know it's in high demand right now, and you're trying to get some answers yourself. You got to come and join us when you get some of that audit data as well. Kevin O'Leary, chairman of O'Leary Ventures and co-host of Shark Tank, alongside Yahoo Finance's Alexandra Semenova. Thank you both.
Take care. Thank you.
Definitely. Coming up, we're going to speak to the CEO of cybersecurity firm CrowdStrike on the back of its third quarter earnings. That's next.
Shares of CrowdStrike took a hit last week following weaker than expected guidance issued for the fourth quarter. The cybersecurity company did beat on third quarter earnings expectations on the top and bottom lines. Revenue was up 53% year over year. For more on the recent quarter and an outlook on the cybersecurity landscape, we're joined by CrowdStrike co-founder and CEO George Kurtz. George, thank you so much for being here, and George is joining us on the phone. First of all, we've had this sort of backdrop during this more constrained corporate spending environment that perhaps cybersecurity would be one of the last things that people wanted to cut. Is that view still intact, given what you are seeing from your clients?
Well, thanks for having me here. I do think it's one of the areas that's difficult to cut. And again, what we talked about were some delays in how some of the contracts were staged and when they wanted to actually start their subscriptions. So the contracts are there. There's some staggered start dates. And I think security is one of those resilient areas that's going to be difficult to cut. And what we're seeing is that customers are really looking to try to consolidate their security spend with fewer vendors. And CrowdStrike is one of those security platforms that they're looking to harmonize around. So we feel good about that. And obviously, when you look at the current environment, the macro backdrop, there's a lot of uncertainties that companies are taking into consideration when they're thinking about their own spend.
When you think about CrowdStrike's growth, do you believe that the company has to do any more acquisitions in the near term in order to continue growing out not just the customer base, but the range of solutions that you're packaging underneath of that kind of parent umbrella?
Well, if you look at the enterprise penetration that we have in terms of modern corporate endpoints, according to IDC, we're number one, but it's 12% and change in terms of share. So there's a massive opportunity that's out there for us in front of us. And I think when you look at these uncertain macroeconomic times, we're really going to be in a great position to look at other acquisitions that are out there. We've got almost $2.5 billion in cash on the balance sheet. There's going to be a lot of companies that are what I call stuck in purgatory. They're not going to be able to get out and become public. People don't want to reset their valuations with new rounds. So we're going to see what's out there. We continue to look at the landscape, and obviously a combination of organic and some tuck-in acquisitions, could be possible, but nothing definitive. And we'll wait and see how the landscape unfolds.
George, what type of cyber security risks do you see companies preparing for next year?
I think it's a lot of what we talked about. Certainly identity is one of the areas that's been in focus. When you look at a lot of these breaches that you've covered or read about or seen, a lot of them are identity-based. 80% of the attacks have some form of credential theft, meaning they've stolen Microsoft sort of Active Directory credentials, and they're using those to move laterally in the environment. And one of the areas that we have focused on, and we did an acquisition a couple of years ago called Preempt, and it's now integrated into the product, is identity threat detection and prevention. And that's been an unbelievable module for us in our new business segment, if you will. It's the number one that we have, and we're excited about being able to protect those identities, which are critical to stopping breaches.
George, just really quickly, what's the biggest emerging threat that you see, the new thing, the next thing on the horizon?
Well, I think there's it really continues to evolve, and I would call it supply chain attacks. And that is, when you think about how companies construct software today, a lot of it is assembly. They'll take open source technology, they'll take other bits, they'll assemble it together, and they'll call it their own. And in that assembly, it is very easy for malicious code to be inserted into that. And, we've seen that over several big breaches that are well known. And I think making sure that supply chain, that code that's being used in your own production environment, keeping that as pristine as possible is going to be very key to success in the future. So we got to keep an eye on that market as well. And, it's one of the areas of real risk that companies are concerned about.
George, I'm not sure how many times you woo-saw in a day, but my goodness, probably a lot. CrowdStrike co-founder and CEO George Kurtz, thanks so much for joining us here today. We appreciate it. We're going to do a final check of the markets coming up next, everyone.
Before we leave you, just checking on the markets as we see some weakness here to kick off the week for the major averages. All three of them down. The Nasdaq leading the way here, off by 0.9%. Coming up in the next hour, Kiko Fujita and Rochelle Akufo will speak with the co-founder of crypto lending platform Nexo, as obviously we've seen some troubles in that industry. You don't want to miss that. We'll be back tomorrow.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast and 8 a.m. on the West. I'm Rochelle Akufo with Akiko Fujita, and here's a look at what we're watching today. Well, tempered optimism. Multiple cities across China ease COVID restrictions, with reports suggesting the so-called reopening will ramp up by midweek. But U.S. stocks fall on fears the Fed could hike the economy into recession. And oil on the boil. The prospect of more demand from China and as steady as she goes OPEC Plus lifting crude this morning. We'll dive into the Russian oil price cap and what it could mean for global supplies. And we'll be joined by the co-founder of Nexo. After the fall of BlockFi, Voyager, and Celsius, it's seen as one of the last big crypto lenders standing. So how is it handling the fallout from FTX and the crypto winter? Don't miss it. But first, let's see how the major indices are trading this morning. We see that all three are in negative territory. The Dow there losing by just about 0.5% there. The S&P down 0.8%. Similar story for the tech-heavy Nasdaq there, down about 94 points. Also want to take a check-in on what we're seeing with the Treasury market as well. We're seeing the 5-year there up about 9 basis points, the 10-year up 8 basis points, the 30-year up 5 basis points. All three, though, up, as you can see there, just about 2.5% there for the 5 and the 10. Now, of course, this is ahead of the Fed's interest rate announcement that's coming next week, as well as insights on economic activity with non-manufacturing PMI for November also coming out on Wednesday. Well, we're starting this hour taking a look at China as it loosens up its COVID restrictions. Now, this is just coming days after a breakout of protests against the country's zero-tolerance approach. Well, for more details, we have Yahoo Finance's Anjali Khemlani. Anjali, what's the latest?
That's right, Rochelle. So now we know that China has been actually slowly entering what seems like a removal of its zero COVID policy. We know it entered a dynamic phase where it locked down certain areas or certain buildings rather than entire cities. And now going a step further, the country is now ending mandatory COVID testing in all public spaces and public transport. There's been a reopening slowly of bars, restaurants, and the like in some of the major cities. However, it's important to point out that there are also some areas that are still clinging to some of these zero COVID policies. So it seems like kind of a mixed picture going into the week after this move from the government over the weekend. This also comes after the country has moved back on isolation and quarantine periods for international travel, as well as allowing some individuals to isolate at home if they do in fact have COVID, especially those who are more vulnerable and may not be able to transport to the quarantine facility. So it isn't entirely moving away. However, we are seeing some movement after those protests calling for an end after 3 years of really stringent policies. So that's where things stand right now. In addition, citizens of China no longer have to provide personal information when buying medication for treating certain ailments. So all this goes down to what seems like a reduction as well in contact tracing in that department. So everything moving into what seems like an easing of COVID restrictions for now, especially after they recently saw a spike in cases, but recently seen a bit of a lower number there. So we'll see how this all pans out on the testing front, seeing a removal of testing booths. So now that all moves into traditional clinical places like we see here.
Yeah, small steps we're seeing taken there in response to those protests. Anjali Kamlani, thanks so much for that. Well, TD Ameritrade has revealed a dip in its latest investor movement index for November, falling slightly from its October score of 4.25. So what were the key themes? Joining us with highlights is Alex Coffey, TD Ameritrade trading strategist. Alex, good to talk to you this morning. Certainly retail investors not immune from the jitters that we have seen in the market. It feels like the overarching theme, at least in the previous month, was really about reducing exposure.
No doubt about it. First off, thanks for having me and covering this behavioral index, which takes a look at what Main Street investors are actually doing with their positions. But I think you highlighted it well. We saw another month of declining exposure and net selling of equities. This is now a 3-month trend of decreasing exposure to risk assets, as well as a 2-month trend of net selling of equity positions. But if we're looking for sort of an optimistic point that may show possibly a bottoming out of this trend, for the 3rd consecutive month, we've seen the rate at which the exposure is being decreased decline. So if you go back to the September month, for example, we saw a decline in the investor movement index of 7.26%. In the October month, we saw it down by 4.92%. And looking at the total TD Ameritrade client population investor movement index for this last November period, the decline was 1.88%. So while it still continues to show a decline in exposure to risk assets, it is a moderating decline, maybe possibly showing that we could see a trend shift here in the next couple months.
And Alex, as we're looking at some of the things that clients have actually been buying at the moment, you've got Tesla there, Taiwan Semiconductor, Intel, Apple, Meta. We're seeing that. Why do you think we're seeing so much movement in there?
Yeah, that's a great question. One thing that I think is important to note throughout the year of 2022, all investors have had to adapt. It's a different market environment that we saw in 2021, and retail investors, just like their professional counterparts, adapt to those market situations. TD Ameritrade, Charles Schwab, Thinkorswim before, all pride themselves on investor education. While we can't take all the credit for what choices that our investors are making and our clients are making, what we can say is, some of the basic messages like buying low and selling high, I think really are represented by the actions taken by TD Ameritrade clients, particularly in the month of November. You mentioned Tesla as one of the primary names that saw buying activity. Tesla was down by about 20% in the November IMX period. This is a name that has outperformed widely many of its peers over the last few years. This is a name that investors have really enjoyed participating in. It's one of the most widely traded names amongst TD Ameritrade clients. It's one of the most widely held names from an investment standpoint by TD Ameritrade clients. And when we see weakness in this name, it is often accompanied by buying activity. So down 20%. We know the reasons why. Obviously, the Twitter distraction has been a big headline, as Elon Musk, of course, has seen some of his attention, if not majority of his attention, going to the social media company that he is now the CEO and sole owner of. But you look at also the Chinese COVID concerns, which have really ramped up, I would say, as we've kind of rounded this final turn to the final month of the year. But there were still concerns from the supply chain standpoint during the November IMX month as well. And of course, there were some recalls as well that were announced regarding some of the Tesla vehicles. Some of the other names you mentioned, TSM, of course, was up 30% over that period with huge October sales figures. So maybe a little bit more confidence coming into the semiconductor space.
Yeah, Alex, you mentioned Tesla. That's a name we hear often when we talk about your retail clients. NVIDIA, another big one. But I'm struck by some of the ones that have names that have been sold here, especially American Airlines, United Airlines, Boeing. I mean, are you starting to see maybe some of the retail clients kind of shifting beyond, sort of the tech focus that we tend to see or we've tended to see in the past?
What I think is most emblematic of what we're seeing amongst the selling activity is these are largely names that have participated recently in the jump in equity prices. So you look at, for example, NVIDIA. It was up 17.5% during the IMX period, but it actually fell towards the latter half of the month after a report from an earnings standpoint that really didn't excite the street. So you had a bounce back in semiconductors, but not really the fundamental information in the case of NVIDIA to back that up. And I think that led to some of the selling rotation out of a name like NVIDIA and maybe into a name like TSM. You mentioned the airline names. As we round this turn and we kind of watch the baton being passed from, let's say, inflation fears to now more economic fears in terms of going into 2023, names that are tied to discretionary spending like travel names in the case of United, in the case of American, are also going to be a little bit more concerning, I think, from an investment standpoint. And I think TD Ameritrade clients rotating out of that reflects that. Also, of course, in the case of American Airlines, highly indebted name. We know, obviously, the interest rate story has been a huge part of 2022 as they have to continue to revolve that corporate debt. That's going to be more pressure on American Airlines. Boeing, you mentioned, one of the strongest performers during the IMX month. One of its strongest months in quite some time as well. So again, another example of rotating out of names that have done quite well and finding buying activity in names that just garner more trust. Names like Apple, names like Microsoft, and names like Tesla with a little bit a wider variety of performance. So if I were to sum it up, I would say buying into names that have a proven track record over the last 5-6 years of success, and rotating out of names that have recently outperformed.
Well, certainly some interesting themes that you're tracking there. A big thank you to Alex Coffey, TD Ameritrade trading strategist. Thank you so much. All right, well, now let's head over to Jared Blick with what's shaking up in the oil market. Hey, Jared.
Well, we got some big news over the weekend here. We're looking at the energy board for today. It is a mixed market. I just want to show you what's happened over the trailing month. Now, we do see still a mixed market, and let me go to the futures so I can show you where the selling has been concentrated over the last month in some of the energy names. Heating oil off 20%, RBOB gasoline off 16%, crude oil down 13%. And without further delay, the news overnight is that OPEC Plus is standing pat. There was some discussion they might actually cut their production a little bit to support prices. We see WTI crude futures are right around $80 per barrel. Now, this is an intraday look, but I want to show a longer term price chart here. This is 20 years. Now, $75 per barrel. Just coming off of those prices. This is a key price that has been in play over the last several decades. Forgive the line, it isn't exact, but it basically splits this huge range you've seen here into two different ranges, and $75 per barrel on the lower end, maybe $125, $130 on the upper end. And this means that if price is able to rebound from here off of the news over the weekend, well, and especially on some of that demand increasing out of China as they relax the restrictions, that would be very supportive of crude oil prices. Also, along those lines, we have seen the premium that is put on the near-month crude oil futures come down considerably. And as China now gradually relaxes the restrictions, we're seeing that rise just a little bit. But I think the bottom line is the world is still kind of awash in oil. We have those that price cap coming down from the EU, $60 per barrel with respect to Russia. That's not entirely having that big of an effect on the market. That does affect prices on the margin, but as we've talked about with a number of guests here, when it comes to oil, it always finds a home. Dark supplies always find a home. So even when there are bans in place, and that's not the price, that's not what we're talking about here, we would expect that oil to find a home. As the bottom line is, we are bouncing off a major potential support area here. So that does give a little bit of a tailwind to oil, and potentially with the reopening, we could see prices rise from here.
Yeah, Jared, really quickly, can we handle that oil price cap? I mean, for those who haven't necessarily been following all this,
Sure.
really two key events that are happening today, the EU coming down with sanctions on oil, and then you've got the price cap in place as well, even if you say you're not seeing a significant movement, at least on the back of that.
Yes, so $60 per barrel is what Russia is being price capped on. It can sell that oil to various European Union members, but it has decided not to. It's going to sell those to other people. If they're selling to India, that means there's a little bit less to sell to somebody else. But given the fact that oil is a globally fungible, that is replaceable and commoditized commodity, that just means that if it's not available somewhere, they're going to find it somewhere else.
Okay, Jared Blickery watching all the action for us this morning. Thanks so much for that. Well, it is time for today's trending ticker, and today we're taking a look at Costco. It has, of course, been crowned Yahoo Finance's Company of the Year. That stock, though, down about 1.3% today. Our very own Brian Sozzi sat down with Costco CEO Craig Jelinek to reflect on the past year and what led to Costco's strength in the face of inflation.
We believe we're the low price leader. Our markup's about 13%. So, you know, any rebate money we get, we pass right on to the consumer. We're a top line company. We drive sales. We're not a margin company.
And joining us now with more, we've got Yahoo Finance's Brian Sozzi. Brian, I know you went out to Washington State to sit down with Craig, but let's talk a bit about why exactly Costco is the Company of the Year. A lot of people are going to say, well, look, it's been a down year. Costco stock is still down. What warrants the big title?
Well, I really just went there for the Costco hot dog, Kiko, the legendary hot dog. And then secondarily, I mean, it's the company of the year because Meta had a terrible year. But no, look, Costco, they outperformed, relatively speaking, from a stock price perspective. Second, this is a company in a year of massive inflation, hitting many households, sending consumers away from grocery stores. This is a company that absolutely thrived. Sales, same-store sales on a monthly basis, pretty much double-digit gains every single month. The company's margins hung in there. They grew memberships, the number of people that have Costco memberships significantly. They're going to probably open over 20 stores over the next, or they probably will open 20 stores over the past 12 months. It has been a beast of a year for this company. And as you would expect, given consumers are trading down in an inflationary environment, really, my hat's off to them.
And Brian, also as we look at within the company in terms of satisfaction of people who work there, Costco really did seem to be ahead of the game when it came to salary and compensation. How much did that factor into this decision?
Well, Costco has long been known for paying some of the best wages in all of retail, in some cases over $20 a pop if you are a cashier. And then also as well, some of the best healthcare compensation. Craig talking to me a little bit about that in another part of the interview. And as a result, I went into the back of this particular Costco store just to see, what was going on in terms of inventory. But in the back of the Costco store, in the employee break room, you see a board just showing how long some employees have been with this company, 20, 25, 30 years. You look at Craig Jelinek, he started the company, I believe, in 1984. His potential successor, Ron Vaccaris, started the company in the early 90s. The CFO, Richard Galanti, he started at the company in the early 80s. He actually led the Series A funding for Costco. I mean, this is a company that is known for promoting from within and treating its employees very well. That's why you have people going from stocking the floors essentially to the C-suite.
I mean, that's an incredible pipeline there. Great stuff. Thank you for getting us up to date on that. Our very own Brian Sozzi. All right, coming up, taking the temperature of the crypto industry. We'll be joined by the co-founder of Nexo. After the fall of BlockFi, Voyager, and Celsius, it's seen as one of the last big crypto lenders standing. That's next.
Well, the fallout from the collapse of FTX continues. High-profile interviews by embattled founder and former CEO Sam Bankman-Fried have further debate on whether he knowingly commingled funds. He has said that he didn't. Well, we asked FTX investor and former spokesperson Kevin O'Leary what he thinks this morning. Take a listen.
By the time this is over, and you ask me what Sam Bankman-Fried did, we'll know. It'll be totally transparent. And until then, I'm not joining the herd. I'm just waiting for the facts.
Well, since BlockFi filed for Chapter 11 bankruptcy protection last week, the question many are asking is, how widespread could the contagion be? Our next guest is Anthony Trenchev. He's the managing partner and co-founder of major crypto lender Nexo. We've also got Yahoo Finance's David Hollerith joining in on the conversation. It is great to have you on at a time when so many people have questions about this space. Now, you have, since the fallout of FTX, sort of put out this statement, Nexo has at least, to say very clearly that you don't have the exposure to FTX, you don't have the exposure to some of these other lenders that have fallen, and yet there are still questions about what exactly your balance sheet looks like. Yes, you've put out the proof of reserves, but they haven't really clarified what you account to be as assets. So, number one, can you clarify that, and how much of those assets actually include your own token, Nexo?
Well, we have been very transparent about that. Out of the total balance sheet, less than 10% are made up by our own native token. That's the Nexo token. You said proof of reserves. We've shown more than actually the proof of reserves, which right now is quite trendy. A lot of companies throwing out their addresses with lots of assets on it. Where we differ is that we have shed light into our liabilities, the other side of the equation, and we have gone the extra mile of showing that our assets exceed liabilities, which very few companies in the space have done. And I think that is one of the reasons that we are navigating through these challenging times better than most. And the underlying business model is the other reason. So for us, this is business unusual. What looked on from the outside as very comparable businesses had very different underpinnings. And, we have been standing the test of time.
Yeah, Anthony, Nexo for a long time has been very active, or I guess you would say is ahead of the game about doing proof of reserves. And I was curious, why stop short of actually disclosing a full balance sheet of showing the assets that are claimed? I bring that up because obviously a lot of what happened with FTX started with Alameda Research having a leaked balance sheet that showed that a lot of the assets they were claiming were FTX tokens. And you obviously pointed out that it's not your token that makes up the majority. But I'm just curious, why not more transparency?
Sure, we are striving for more transparency always. I think the major problem with FTX and Alameda was the fact that they have been very heavily borrowing against their own token. If you looked at the leaked balance sheet by Alameda, you will see that they have on their balance sheet more FTT than there is in circulating supply. So that is the problem, is the way that the fact that they have been borrowing against their own token, which we have not. In terms of transparency, we are different than an exchange, and we spend some time in trying to explain that. We have an exchange functionality, but we have a smart ordering routing system that sends out custom orders through various different exchanges, which is very different than a traditional exchange, which has its own order books, and ideally all the assets stay within those assets, and they just addresses, and they are just matching the orders of the various clients. Our system, because we came in later into the game, we saw advantage elsewhere, creating this smart order routing system that it gives you best price execution. And the byproduct of this is, for this to function well, you have to keep balances across different exchanges. And we also keep a lot of assets that are off-chain. So it is not so easy to do this Merkle tree type of audit on a company such as Nexo. That's why we did what I believe to be the next best thing, is to partner up with a third-party auditor who can see the full picture, vouch with their authority and reputation that our assets exceed liabilities. And we did that, last year when times were good, Bitcoin was flying from one record high to the next. We were preparing and future-proofing and safeguarding the enterprise against the very concepts and contagion like viruses that are spreading across the industry. So I think that we are one of the better examples for transparency in the blockchain space.
And Anthony, I want to ask you about these yields. Some of these are quite enviable, 10% on some of these stable coins. How are you able to provide such yields? And what does it mean then when you have a crypto winter and you're seeing the value of some of these tokens declining so quickly?
Well, we have to be completely honest here. These highest yields that are achievable and some people earn those interest rates are not necessarily representative of the entire book and asset mix, because to earn 10%, you have to have a certain amount of Nexo tokens. There are certain limits up to the amounts that can earn those interests. It's like, we have this internal joke that when you see a billboard of the new Mercedes S-Class and it says starting only $70,000 and they show you the S63 AMG, which has every possible feature and extras on it. Obviously, this particular model costs slightly more. So as an aggregate, the average client earns much smaller percentage yields. And the reason for that is that we, as a company, we've never relied on outside financing. Short from our token sale in 2018, we have no outside financing, so no fancy VCs which have given us money to, burn on customer acquisition. We bootstrapped the whole thing. We had a profitable and have a profitable business model to this day. So we try to make this economically sound in a way that we can continuously generate and yield and deliver good solutions for our clients.
Anthony, let me try to press on that point. And I want to pull up a tweet here from a Bitcoin analyst who I think kind of bottoms line the question for us. He says, ask yourself how Nexo is paying 10% on stable coins while DeFi yields are 1%, short duration US treasuries are 4.5%. And then he goes on to say, if the yield is greater than the risk-free market rate, they are by definition taking directional risk to chase said yield. How do you respond to that?
Well, just to reiterate the point, as an aggregate, all combined, our clients are not earning 10%. They're earning a much smaller percentage. And we are seeing opportunities in the market to generate that yield for our clients in a market neutral, safe way. We have disclosures in place which stipulate what we are doing with those assets. So what you get is what you signed up for. And the fact that, after this colossal fails, after redemptions, which have been sizable in the past 9 months, our systems are processing both deposits and withdrawals in real time without having to resort to any sort of bailouts, without having to resort to lock-ins, without having to resort to any sort of restriction on customer activity. I think it speaks volumes in and on itself about the sustainability of our business model, the stringent risk management policies that we have in place, and quite frankly, that we know what we're doing.
Yeah, and just 30 seconds here, but I know that Nexo came out as very strong in wanting to acquire companies this summer. Up to this point, it sounds like outside of an acquisition and a small stake in a U.S. bank, there hasn't really been any acquisitions that have sort of been, the transaction has been completed. I was just curious, why hasn't Nexo acquired more companies as it has sort of set out to do since the summer?
Well, this is actually what differentiates you being a prudent business, that it takes time to audit companies, to see their financial states and to make the decision to acquire and not acquire them. The type of panicky acquisition of companies which happen to have outstanding credit lines to you, this is what is unsustainable. And the last one who was doing that was doing it for the sole purpose of the loans that he had received not being called back. So for him, and obviously I'm talking about Sam Bankman-Fried, FTX, and Alameda, it was a lack of choice. They had to acquire those companies in a frenzy, whereas for us this is by no means at all costs. We can do the due diligence, wait to see what assets can be retrieved from the companies such as Volt, where we are potentially looking to acquire it, and then make rational decisions that make business sense and deliver value both for the existing customers that are locked out outside their funds, and both for Nexo clients and us as investors. That is the main difference.
We will have to leave it there, but we do thank you for joining us with your insights this morning. Anthony Trenchev, their managing partner and co-founder of crypto lender Nexo, and of course Yahoo Finance's David Hollerer. Thank you for joining us. All right, coming up, Shanghai surprise. Tesla denies media reports it plans to cut December output at its giant gigafactory in China. So is demand holding up or not? We'll discuss next.
Welcome back to Yahoo Finance Live. Tesla this morning denying reports it plans to cut December output at its gigafactory over in China. Despite shares down for 2022, our next guest says that the EV maker has really led the charge in this space and, in fact, fundamentally changed the industry. Joining us now is Jeff Osborne Cowen, Senior Research Analyst covering the sustainability mobility technology sector. Jeff, you've got a light read, a massive 475-page report where you partnered with 16 other analysts at the firm to come up with over 50 stocks that could benefit in the EV space. But I want to start with your outlook here, because you've talked about EV penetration being at well over 20% by 2025. That is a much faster clip than forecasts in the past. Who stands to benefit the most?
Yeah, certainly Tesla did pave the way for the EV train to leave the station, so to speak. But we see a variety of different companies benefiting at Cowen, starting with semiconductors. You have about 2 to 3 times the number of semiconductors in an electric vehicle as you do an internal combustion engine vehicle. Some of the tier 1 suppliers that I cover, Aptiv, for example, is a top idea of mine, as well as Visteon. But there's a variety of plays. Charging and lithium in particular as well are gating obstacles to grow the industry. So as you mentioned, 15 50 ideas that we came up with, a variety of companies in the tech space in general.
And so you mentioned some constraints there, what we might see with semiconductors and also what we're seeing with lithium batteries. When you do have this influx of EV adoption coming on, how prepared is the industry to deal with those constraints?
Yeah, certainly the semiconductor industry has ramped up a lot quicker. The battery capacity has ramped up. It does take, unfortunately, about 4 to 7 years to build a mine versus a year to build a new factory for chips and batteries. So that's really where the disconnect is that you're seeing. I think between now and say 2027, you have a bit of a red line in the industry as to how quick this industry can grow. But when you look beyond that, you're seeing the OEMs, GM, Ford, Tesla, going straight to the mines. That's allowing them to get better funding terms and move the industry forward. So I'm very bullish when we look beyond the midpoint of the decade, especially heading out to 2030, where I think you'll get well into the 30 to 35% penetration for electric vehicles.
There's one particular name you're especially bullish on, SolarEdge Technologies, saying that's the best idea for 2023. Walk me through your thesis.
Sure. I cover two different worlds. So on the renewable energy side, SolarEdge is our top idea for 2023. It's a solar inverter company. So think of it as a router for electrons that are coming off of your solar panels. And you're seeing a nice tying together with EVs. When you buy an EV, about 30 to 50% of your electricity consumption is increased at your home. And so more EV owners are going solar, see SolarEdge leading the charge, so to speak, in terms of their ability to manage the electron. So pairing with batteries, pairing with EV chargers, and really being a better constituent with the grid to allow solar to interoperate with utility networks in a much better fashion.
And just quickly, I want to ask you about the voltage changes that we're seeing. Originally, we tended to see them in the 400 range, but you're starting to see them in the 800 range as well. What is that going to do to the industry?
Yeah, you're spot on. So consumers want to charge faster. They also want to charge quicker. And so to do that, you need to increase the voltage in the car. And so that has a profound impact on the types of semiconductors used. You move to what's referred to as silicon carbide. So that could be companies like STMicro, Infineon, Wolfspeed that my colleagues Josh Buckhalter and Matt Ramsey cover. But it also has an impact on the tier one suppliers. So companies like Aptiv and Visteon benefit there. And so Tesla, which you're showing on the screen, uses a sub 400 volt wiring harness. But you are seeing quite a few new vehicles led by the Porsche Taycan and Hyundai's family of vehicles using 800 volt. And there's certainly a lot of attributes that benefits the consumer in terms of faster charging and better range.
All right, thank you so much, Cowen Senior Research Analyst Jeff Osborne. Thank you for joining us this morning. All right, coming up, battling the blizzard. Reports suggest Microsoft is ready to fight for Activision as uncertainty over the takeover persists. So what does that fight actually look like? We'll ask Yahoo Finance's Dan Howley next. with the FTC potentially split on whether or not to approve Microsoft's $69 billion purchase of Activision Blizzard, the Call of Duty developer is reportedly planning to fight for the deal in court if it gets blocked. Yahoo Finance's Dan Howley has the latest. So, Dan, give us an update.
Yeah, this is could be the first case that really turns Microsoft into the bad guy since it faced their antitrust lawsuits in the late 90s and early 2000s with regards to Internet Explorer and Windows. The company really has been kind of, for better lack of a better term, the good guy when it comes to Silicon Valley and the current spat of investigations, or at least having government looking into companies like Apple, Google, Amazon, and Meta as far as antitrust violations go, or potential antitrust violations go. But this, if the FTC does move forward, we could see them try to sue to block Microsoft from fully acquiring Activision Blizzard for that $69 billion, the largest acquisition in Microsoft's history. And that would mean that Microsoft would be back to square one with the government, at least as far as antitrust goes, and its positioning. It's been very diligent about ensuring that it's not lumped in with its cohort as far as antitrust violations go. It's called out Apple for the App Store and saying that there needs to be, a way for developers to get their apps onto all devices. So this would be an interesting kind of change for them on that front. But as far as why they want it, there's two real reasons. It's their Game Pass service, their cloud gaming platform. They want to make sure that that's the future. And some of the experts that I spoke to say that Microsoft doesn't see game consoles existing in the next 20, 30, 50 years. There'll be cloud-based platforms where you can play games on any device that you have. The other thing is mobile. Activision Blizzard has King, which is one of the largest mobile platforms or mobile game developers out there, or publishers out there. And so they would be able to get their hands on that. And then that would ensure that they are able to play in both the the mobile console and PC space. And it's important to point out that mobile is the fastest growing gaming sector out there. So they would really start to set themselves up as one of the larger gaming giants. And if they did acquire Activision Blizzard, they would become the number 3 gaming platform behind Tencent and Sony.
Okay, Dan Howley giving us the very latest on that deal. Thanks so much for that. Well, this just in, Slack CEO Stuart Butterfield is reportedly set to exit Salesforce in January. That's according to Business Insider. Stuart Butterfield reportedly announcing this in an internal Slack channel this morning. That's at least what the insider is reporting. This, of course, comes just days after the departure, or the announcement of the departure of Salesforce co-CEO Bret Taylor, although Butterfield reportedly saying that this has nothing to do with that this has been in the works. And you see Salesforce's stock down about 3.7%. Well, coming up, from financial performance to leadership and the impact on society, a lot goes into choosing our company of the year. We're going to take a closer look at Costco on the other side of the break. Well, Costco may be Yahoo Finance's 2022 Company of the Year, but its smaller retail rivals like Sam's Club and BJ's Wholesale Club are giving the wholesale giant and some customers something to think about. Brooke DePalma checked out all three and is here to share what she found. Brooke, are we talking about pricing or is it more about the membership?
Well, Akiko, it's really about the feel overall. And surprisingly, when I entered each three, there was a bit of a different feel at each. Now, when you walk in here, similar high ceilings, bulk item offerings, but it's a different approach at each of the three. BJ's and Sam's Club really touting that holiday feel with toys lined to my right. Then you have more random spontaneous items like air fryers and cots to my left. But Costco sticking to what it always has with that luxury feel as soon as you walk in. Now, admittedly, I did not have a membership at any of the three, but they still did let me walk around. And if you take a look at pricing, Akiko, that is one of the main differences that I found. Of course, Costco known for that $60 per year membership, also offering a higher executive membership for $120 with a 2% annual reward, as well as, in addition to that, a services discount. Of course, a lot of them have optometry, hearing aid centers, and that tire services centers. Sam's Club, that's about $50 for the main reward. Gold Star membership $110, and BJ's coming in between the two, $55 for main, as well as a Perk Rewards membership that equates to $110. Now, it's important to note here, this past year as inflation takes a toll and they're seeing higher volume in each of them, Sam's Club took protocol to then raise their price in August. And Costco, important to note here, they increase price memberships about every 5 years. So we might be expecting another price membership hike in 2023. Now, all three tout gas stations at their locations. Costco has the most locations, then followed by Sam's Club and BJ's. So Costco, of course, our company of the year here with the most locations of all three wholesale retailers.
I know that certainly helped with the pinch of higher gas prices for a lot of people. Brooke DePalma, thank you so much. And of course, what really powers Costco is its employees. And recently, we've seen the Teamsters Union say it had ratified a national contract with the company. Well, joining us now on the implications is Carla Walter, Center for American Progress Employment Policy Senior Director, Employment Policy, and Chris Tilley, economist and professor of urban planning at UCLA. Thank you both for joining us. So, Carla, I first want to start with you and talk about the importance of what we've seen in terms of this union movement and how Costco has really managed this.
Yeah, so I think we've seen the recent announcement between the Teamsters and the company that they've reached an agreement that will cover 18,000 of its workers nationwide. And this is a big deal. It is coast-to-coast agreement. The new contract was negotiated. It's important to note that while Costco has long had the strategy of when its workers do well, the company does well as well. This is an agreement that came where unions and the company came to the table and negotiated together and got to something good for workers that the workers ultimately ratified. But this is in stark contrast from what we've seen from a lot of its competitors who really, even in the face of increased organizing and at union activity, are still pursuing a low wage strategy.
Chris, it's worth pointing out that Costco has had to manage unions, partly because they acquired a lot of stores with unions when they had that acquisition of Price Club way back when. They have managed to be able to keep the employees happy, sort of maintain a smaller footprint of unionization in their stores. But I wonder how much of that pressure is increasing as we see some competitors like a Sam's Club, like a Walmart, up their benefits, up their prices to be a little more competitive.
Well, I think that there's two sources of pressure. One is, in fact, that competitive pressure. But as Carla was saying, Costco has taken a high road where its competitors have taken a low road. And that approach has worked and will continue to work in many ways. Nonetheless, there's also a source of pressure because as inflation goes up, workers' expenses go up, and Costco sort of has to keep pace with that. That's what happened with these negotiations, is that Costco offered a settlement that workers turned down 93% in August and threatened to go on strike. And so I think that's the other source of pressure. And that's going to continue both because inflation is continuing and because right now the worker shortage is continuing.
Chris, how much of this has to do with the model that Costco operates on? I've heard others say that, look, even though, Costco has been very friendly to employees historically, part of that is also because so much of the revenue is reliant on membership instead of a company like Amazon, which is about item by item, the speed at which it's delivered. That really ups the pressure for employees.
Well, first of all, when you're talking about Amazon, you have to realize that, in fact, the Amazon Web Services is subsidizing the whole retail operation. So in many ways, Amazon is operating retail at a loss and using the cloud services to subsidize it. But yes, Costco does have a different model. It aims for a somewhat higher income customer. It does have the membership fees. It has the treasure hunt and the luxury look that your reporter was talking about. And that's never going to be the entire market, but it's an important part of the market, and Costco has continued to grow.
And when we talk about things like customer experience, a lot of that trickles down to the people that you do meet on the front lines, the people who work there, Carla. How do you think that's going to play into the greater retail story going forward?
Well, I think that there is truly this sort of fact that there is a recognition that at Costco that this is a sales job. And so if you have workers on the floor who stick around longer, and ultimately if you invest in workers, they do stick around longer, they will understand what they're doing and they'll understand the job of selling. And I think, though, looking more broadly, it's important to show that Costco's success really debunks the myth that there's something innate about frontline service work that makes it low wage. Some of our largest employers in the U.S. are these frontline service jobs, employ these workers in these frontline service jobs. And there is nothing necessarily about those jobs that make them low wage. It is about power in the workplace, and it is about employer choices. And so I think that the Costco model is an important comparator, particularly as we see workers exercising their power to put pressure on these other employers to do better.
Carla, really quickly, when you look at how the Teamsters negotiation played out with the Costco workers over the summer, there was a threat of a stoppage at some point before the Teamsters ultimately accepted the offer that was given here. And I wonder if there were any lessons to be learned from that negotiation for some other retailers in the space, or others like Starbucks, who are getting a lot of pushback from their employees right now.
Well, I think it shows that, labor negotiations are a negotiation, but when workers are truly at the table, you can get ultimately to a success story. And I think we see, though, that there is truly, when we talk about Starbucks, when we talk about Amazon, employers are choosing to fight tooth and nail. And in today's labor market, that is truly a problem for them.
Carla Walter, Center for American Progress Employment Policy, Senior Director, Employment Policy, and Chris Tilley, economist and professor of urban planning at UCLA. Appreciate both of you joining us today. Thanks so much for your time. And we'll be right back.
Well, let's do a final check of the markets to see where things stand before we close out. Here we see the Dow there down more than 1% now. The S&P 500 down almost 1.5%. Same situation for the tech-heavy NASDAQ. That is also down about 1.5% as well. And even as we take a look at some of the market action that we're seeing today, we're seeing that when it comes for the sector action, we're seeing utilities down the most. We're also seeing in terms of consumer discretionary, that's down the most. That's down more than 2% at the moment. So really not seeing any positive sectors there across the spider sectors at the moment. We'll see if these losses continue, obviously bracing for the Fed announcement and other details coming out next week. Akiko.
Yeah, Rochelle, worth noting that we have seen those declines accelerate since we got the ISM services number out this morning. Looking at where they came in November, came in hotter than expected, certainly adding to these concerns that Fed will continue to tighten for longer. There was a bit of an easing pressure when you think about where things came in terms of the inflation print. But now we're looking at some of these declines on the back of the November ISM services, the index posting a 56.5% reading. That is well higher than what was anticipated there. Finally, all three major indices, as Rochelle said, down right now. We have also seen the bond yields push higher on the back of this as well. We're going to continue to monitor all the market action, of course, and have coverage for you on our Company of the Year, Costco, throughout the day. But that does it for Rochelle and I in the 11 a.m. Eastern hour. Thanks so much for watching. We'll be right back here tomorrow.